So today we are going to start with the chapter of recovery of taxes. This chapter 17 in the Income Tax Act. When we started with the first chapter, that is basic concept, I had told you that income of previous year is chargeable to tax in the assessment year. Even though we say that income of previous year is chargeable to tax in the assessment year, chargeable to tax in the assessment year means your income will be ascertained in the assessment year. Your tax liability will be ascertained in the assessment year. But the actual tax collection happens in the previous year itself. So even though income of previous year is chargeable to tax in the assessment year, actual tax collection is done in the previous year itself by three different mechanisms. Number one is TDS, number two is TCS, and number three is advance tax. So there are three different mechanisms for collection of tax: TDS, TCS, and advance tax. These are three different parts of this chapter. See, as I told you yesterday itself, that this chapter is full of theory. So there are practical questions, but practical question solving will take 3-4 minutes time. That's all. Small questions, case study type question, but it is full of theory. So I have summary notes also in front of me. Entire TDS, TCS, advanced tax, this chapter is summarized in 16 pages. Whereas if you find out in textbook, it might be more than 50 pages. I think in the book is starting from 304, page number 304 to 357. So basically, it is 54 pages in the book. These 54 pages are summarized here in 16 pages. Page number in your textbook, it is page number 304. 304. Summary notes are uploaded in the app. Summary notes are uploaded in the app. So in that, you can refer to that chapter entirely from the summary notes only. That will be more helpful. In a short span of time, you can complete the chapter. So let's move on to this recovery of taxes. As I told you, income of previous year is chargeable to tax and assessment year, but actual tax collection does not happen in the assessment year. Actual tax collection happens in the previous year itself by three different mechanisms. Number one is TDS, number two is TCS, and number three is advance tax. Even after paying taxes in the form of TDS, TCS, advance tax, even after paying taxes through three different mechanisms in the previous year itself, still if there is some tax payable, then that tax can be paid at the time of filing the income tax return, and that is called as self-assessment tax. That is termed as what? Self-assessment tax. So even if after paying taxes in the form of TDS, TCS, advance tax in the previous year itself, thereafter also, if some tax is due, that tax can be paid at the time of filing income tax return, and that is called as self-assessment tax. Now, out of these three parts, first of all, we'll move on to part one, that is tax deducted at source, TDS. See, let us take an example of a transaction. There is a transaction between me and Inside Commerce Studies. I am rendering professional services to them, and they are going to pay money for that, pay professional fees for that. They are paying professional fees, so they become payer. I am receiving professional fees, so I am a payee. For payer, it is an expense. For payee, it is an income. But in this chapter, we'll be using the word income only. Instead of using the word expense, we'll be using the word income. So payer is paying expenses and payer is paying income and pay is receiving income. Payer is paying income and pay is receiving income. So in our example, inside commerce studies is paying income, whereas I am receiving income. Inside commerce studies is payer, I am paying. So first of all, we'll discuss some general rules with respect to TDS. So TDS stands for tax deducted source. When the payer pays income to the payee, he should deduct some amount of tax and pay to the government. So inside commerce studies is payer, I am paying. There are 4 duties assigned to the payer in the income tax. Number 1, deduct tax. So while they are paying money to me, while they are paying professional fees to me, they should deduct tax. Number 2, whatever tax they have deducted, they should pay this tax to the government. Whatever tax they have deducted, this tax they should pay to the government. Number 3, they should file their TDS return. The way we file our income tax return, similarly there is something called as TDS return. So inside commerce studies, we'll have to file the TDS return. TDS return means in that return, details will be given as to how much tax was deducted, whose tax was deducted, name of the payee, address of the payee, PAN number of payee, how much amount was paid, under which section tax was deducted, at what rate tax was deducted, and on which date this tax was paid to the credit of government. All these details would be forming part of TDS return. So TDS return is basically, in income tax return we declare our income, whereas in TDS return we declare the details with respect to tax deducted and paid to the government. So there are broadly 4 duties of payer. First duty is to deduct the tax. First duty is to deduct the tax. Second duty of payer is to pay tax to the government. Second duty of the payer is to pay tax to the government. Third duty of the payer is to file the TDS return. Third duty of the payer is to file the TDS return. And the last and the fourth duty of the payer is to issue the TDS certificate to the payee. So inside commerce studies will do 4 things. Number 1, they will deduct my tax. Number 2, they will pay this tax to the government. Number 3, they will file the TDS return in which they will mention that whose tax they have deducted, at what rate, and which section, when they have deducted and when they have paid to the government. And the fourth one is they will issue the TDS certificate to me. They will issue the TDS certificate to me. TDS certificate will clearly mention how much tax they have deducted, on which date they have deducted, what is the rate of tax, rate of TDS they have deducted, which section they have deducted TDS. This all things will be mentioned in TDS certificate. So we are now going to discuss some general important points to be kept in mind with respect to TDS provision. First is, in this chapter, if there is any default, then payer is liable for the default. Payer is responsible for the default. Payer will have to face disallowance of the expenditure. Payer will have to pay penalty. Payer will have to pay interest, fees, etc. So if there is a default in this chapter, there is a default in deducting TDS, there is a default in paying TDS. In all these cases, payer will be at default and payer will face consequences. Point 2, TDS only if this section provides for it. TDS can be deducted only if section provides for it. If there is no section for deducting TDS, then TDS will not be deducted. For example, inside commerce studies is paying me professional fees. So for professional fees, there is a section 194J. So in this section 194J, TDS will be deducted. If there is no section, say for example, you are paying fees to inside commerce studies. You are paying fees to inside commerce studies. In that case, you are payer and inside commerce studies is paying. But you are not deducting TDS. You are paying the entire fees to inside commerce studies without deducting any tax. Why so? Because there is no section to deduct the TDS. There is no section to deduct the TDS. So without a section, TDS cannot be deducted. TDS can be deducted only if there is a section. Point 3, TDS to be deducted only one section. You cannot apply multiple sections to the same situation. Only one section can be applied in a particular situation. Section 191 talks about direct payment. Say for example, 194J talks about TDS on professional fees. So inside commerce studies is paying me professional fees, then they are supposed to deduct TDS at the rate of 10%. They are supposed to deduct tax at the rate of 10%. So they will deduct tax at 10%. But say for example, I am falling into 20% slab or 30% slab. Then my income will be taxed at either 20% or 30%. For example, my total income is beyond 10 lakhs. In that case, what will happen? In that case, I have to pay tax at 30%. On the income about 10 lakh, I have to pay tax at 30%. But inside commerce studies will deduct only 10% because TDS section is different. So TDS rates and tax rates are different. In the chapter of basic concept, whatever we have discussed, they were tax rates. And whatever we'll be discussing in this chapter is a TDS rate. They both are different. Ultimately, tax is payable to the government at tax rate only, but TDS is just a mechanism to collect the tax. And TDS rates are generally lower than the tax rates. So I'm telling you that, say for example, my income is liable for tax deduction at source as per section 194J. But inside commerce studies, they are deducting 10% tax, whereas I am falling into 30% tax slab. In that case, who will pay the differential amount of 20%? That 20% I have to pay tax directly to the government. That 20% I have to pay tax directly to the government. If I don't pay that amount to the government, then government has a right to demand that from me. Government has a right to demand that tax from me. Another possibility is you are paying fees to inside commerce studies. For that, there is no section. Therefore, you are not deducting TDS. So, what about the tax on the income earned by inside commerce studies? Tax on that income is required to be paid by inside commerce studies directly to the government. So, when there will be a direct payment to the government, number one, when the income is not subject to TDS, means there is no section to deduct TDS. Or number two, income is subject to TDS, but TDS is not deducted, then the payee shall pay tax directly. Either inside commerce studies, they have forgot to deduct my TDS, or they have deducted TDS, but I am falling into higher slab. In that case, I have to pay tax directly to the government. Yes, have you understood this? Yes or no? Okay, let us proceed further. This is budget 2020 amendment. This is related to section 80 IAC. Actually, 80 IAC is not in your syllabus. That is the reason in the chapter of deductions, we have not covered this 80 IAC. 80 IAC is a section relating to eligible startup. If there is a startup company, if there is a eligible startup company, then they enjoy a tax holiday for few years. They enjoy a tax holiday for few years. Now here we are saying that if this eligible startup company is issuing equity shares or securities under ESOP scheme to the employee, then what will happen? Sarvana, eligible startup means they have to fulfill certain conditions. Now I don't want to get into those conditions because it is not part of your syllabus. So eligible startup means a startup who has a potential of generating more employment. There is a interministerial board of certification, IMBC, that will certify whether you are eligible startup or not. So if you have if you have started some new business which is technology based business, and it has a potential of generating employment. In that case, that business will be called as eligible startup. Eligible startup companies generally issue shares and securities to their employees in the form of ESOP. So, you know that as per section 17 subsection 2 clause 6, this is already taught to you in the chapter of income from salaries. Whatever shares securities are issued under ESOP to the employee, on that they have to pay the tax. That amount is taxable. In which year it is taxable? Year of taxability is year of allotment of shares. And taxable value of perquisite equals to what? Number of shares allotted multiplied by fair market value of shares on the date of application minus amount recovered from employee. Now here we are talking about the direct payment. Here we are talking about the direct payment. Meaning whereby if the employer has allotted shares to employee under ESOP scheme and he has not deducted the tax, he has not deducted the tax. In that case, tax is required to be paid directly by the employee to the government. Directly, employee has to pay tax to the government. And what is the time limit for paying such tax to the government is there are three time which is given. Three period is given. Point number 1, 2, 3. You calculate all these three periods. From that, you select whichever is earlier period. By that date, the tax is required to be paid directly to the government. So, which is effect from assessment at 21-22 in respect of income referred to in 17 to clause 6 and such specified sweat equity shares referred to in that clause are allotted directly or indirectly by current employer being eligible startup company referred to in section 80 IAC. What will happen? Income tax on such income shall be payable by the SSC within 14 days. So, eligible startup is issuing share securities either free of cost or at concessional rate to its employees under the ESOP scheme. In that case, if they have not deducted TDS, then employee has to pay tax directly to the government within 14 days. Within 14 days from which date? After the expiry of 48 months from the end of the relevant assessment. After the expiry of 48 months from the end of the relevant assessment year. Relevant assessment year means relevant to the previous year in which the shares of securities are allotted. So generally, taxability arises in the year of allotment only. But here, in budget 2020, government has inserted an amendment. Government has amended the provision, and in case of an eligible startup company, government has postponed the tax collection. Government has postponed the tax collection. So, if the employer do not deduct the tax, in that case, employee will be liable to pay tax directly to the government, and that is required to be paid within 14 days after the expiry of 48 months. So basically, after the expiry of 4 years from the end of the relevant assessment year. A relevant assessment year means the year in which the shares are actually allotted, or 14 days from the date of sale of such specified security or sweat equity shares by the SSC. Whatever shares securities employer has issued to the employee, those shares securities employee can sell it in future. If he sells, then from the date of sale within 14 days, this tax on ESOP is required to be paid to the government. Or 14 days from the date the SSC ceases to be an employee of the company. So an individual has joined the company. He has joined a particular company. Then, if shares are allotted to that individual employee under the ESOP scheme, thereafter, if that individual resigns from the company, he is leaving the job to join some other company. In that case, from the date of resignation, you count 14 days. So you have to count 14 days from which date? 14 days from the expiry of 48 months from the end of relevant assessment year, or 14 days from the date of sale, or 14 days from the date of resignation. All these three things you have to count, and then you have to select whichever is earliest. Then you have to select whichever is earliest. By that date, employee is supposed to pay tax to the government directly. If the tax is not deducted, then employee should pay tax directly to the government within this time limit. See, generally year of allotment taxability arises in the year of allotment. But by amending the Income Tax Act, by amending Section 80, by amending Section 191 subsection 2 and Section 192 as well, this amendment is introduced only for eligible startup. By this amendment, government has postponed the tax collection in case of eligible startup. So in case of eligible startup, tax collection is postponed. Section 205, bar on direct demand on the SSC. Bar on direct demand on the SSC means the restriction on direct demand on the SSC. See, I am SSC inside commerce studies. They are payer, I am paying. So, can government directly demand tax from me? If inside commerce studies they have deducted my TDS, inside commerce studies they have deducted my TDS, but they are not paid this TDS to the government. Can government demand tax directly from me, saying that you have not got the tax amount? Answer is no. Why? Because my tax is already deducted, na. Why I should be forced to pay twice? I did not ask the government to come out with the TDS mechanism. Government has, they themselves have come out with the TDS mechanism, and payer has deducted my TDS. If payer has deducted my TDS, amount which I would have received is less, na. For example, they are paying me 50,000 rupees. On that, they should deduct tax at 10%, that is 5,000. So they have deducted 5,000. If they do not pay this 5,000 to the government, then government cannot demand this 5,000 from me, saying that we have not received. It is their fault. They have made the provision. So inside commerce studies, they have defaulted. Then they have to face the consequence. Government cannot demand that amount from me because from the payment which I have received, that amount of tax is already deducted. If government demands tax from me, then that would amount to double taxes. Therefore, we are saying that there is a restriction on the direct demand from the asset. If the payer of the income has deducted tax as it was deductible from the income, then whether or not it has been paid to the credit of government, the payee shall not be called upon to pay tax himself to the extent it was deducted. So, to the extent tax is deducted, government cannot call me to pay the tax directly. Have you understood this much? Yes or no? Okay. Now question is when to deduct tax. Question is when to deduct tax. See, tax can be deducted on two occasions. Tax can be deducted on two occasions. There are different sections for deducting tax, and this tax can be deducted on two occasions. Can you see the word file? This section says the tax needs to be deducted at the time of payment. At the time of payment or at the time of crediting his account, which was earlier. So there are two possibilities. There are two possibilities. Possibility number one, section will either say that tax needs to be deducted at the time of payment or at the time of crediting pays account, which was earlier. At the time of payment or at the time of crediting pays account, which is earlier. See, inside commerce studies, they are paying professional fees to me. So they are supposed to pass the entry in the books of account. Now they will pass some entry in the books of account. There are two possibilities. Number one, they are passing an entry professional fees account debit to bank account. They are passing one entry professional fees account debit to bank account. In that case, they are crediting bank or no? They are what entry they will pass? Professional fees account debit to bank account. They are crediting bank on means they are making the actual payment. Then they should deduct TDS. This is one possibility. Another possibility is they are passing an entry. They are passing an entry professional fees account debit to Mr. Jignesh account. They are passing an entry professional fees account debit to Mr. Jignesh account. Professional fees account debit to pay his account. They are crediting my account. In future, they will pass an entry. The Jignesh account debit to bank account. To bank account. The question is when they should deduct the TDS. Say for example, the first entry is passed on 1st January 2021. This entry is passed on 1st January 21. Whereas second entry is passed on 1st February 21. This is one possibility. Another possibility is they have passed only single entry. Only one entry they have passed. Professional fees account debit to bank account. Now the question is when they should deduct the TDS. Government says TDS should be deducted at the time of payment or at the time of crediting pays account whichever is early. If government is using this language, in that case, we should look at the dates. On which date pays account was credited in our example? Pays account was credited on 1st January 21. On which date the payment was actually made? Payment was actually made on 1st February 21. So when they should deduct TDS? They should deduct TDS out of these two dates, whichever date is earlier. On that occasion, they should deduct TDS. So 1st of February or 1st January, whichever is earlier, they should deduct tax on 1st January. Is that very clear? Now say for example, second possibility, they have directly passed an entry. They have directly passed an entry, professional fees account debit to bank account. They have directly passed an entry, professional fees account debit to bank account. They have directly passed the entry, professional fees to bank. In that case, they have not credited the pays account directly. They are crediting the bank account. In that case, they should deduct TDS on that day, 1st January 20. So if the section uses the language tax should be deducted at the time of payment or at the time of credit, which was earlier, then you should see on which date pays account is credited. You should see on which date bank account is credited. Then you should find out which date is earlier. On that date, you should deduct the TDS. Second possibility is section can use the language tax needs to be deducted at the time of actual payment. If section is using this language, tax needs to be deducted at the time of actual payment. Then what will happen? In this first case, tax needs to be deducted on which date? 1st January 21. Correct? In second case, it will be deducted on, say for example, let me change the date. This 1st February or 1st March. Then that needs to be deducted on 1st March. Second possibility is section uses the language tax needs to be deducted at the time of actual payment. In that case, the first case tax will be deducted on which date? It will be deducted on 1st February. It will be deducted on 1st February. And in second case, it will be deducted on 1st March. Yes, have you understood this? It is very simple. When the section says tax needs to be deducted at the time of actual payment, means tax will be deducted along with the bank account. When the bank account is credited, at that point of time, tax will be deducted. If section uses the language at the time of payment or at the time of crediting pays account, which was earlier, then you have to see when you have created the pays account, when you have created the bank account, out of that which date is earlier, on that occasion you should deduct the tax. So here we are saying that tax needs to be deducted at the time of crediting pays account or at the time of payment, which was earlier in point of time. However, this is the list of section. This is the list of section in case of which tax needs to be deducted only at the time of actual payment. This is the list of section in case of which tax needs to be deducted only at the time of actual payment. In other words, when bank account is credited, at that point of time, tax will be deducted in this section. All other sections, other than this list, all other sections, tax will be deducted at the time of payment or at the time of crediting pays account, which was earlier. Whereas in case of these sections, tax will be deducted at the time of payment only. What is the rate of TDS? That we'll discuss when we get into different sections. But yes, slightly I'm giving an idea. If you are making payment of salary, or you are making payment to a non-resident person, Dikshit, in second example, we simply said that when the bank account will be credited, only at that point of time tax will be deducted. In second example, we simply said that tax will be deducted only when the bank account is credited. So in second example, look at first case, when bank account is credited on 1st February 2021. So when tax will be deducted? On 1st February 21. In second example, second case, bank account is created on 1st March. So when tax will be deducted? It will be deducted on 1st March. Correct? Okay, now look here, rate of TDS. See, I already told you that rate of TDS and rate of tax both are different. Rate of TDS is given in the respective section. But what is given in the respective section, that's what we need to understand here. If you are paying salary or you are making payment to any non-resident person, then the TDS needs to be deducted at the rate applicable to the pay. Whatever is the rate of tax, that will be the rate of TDS. In case you are making payment to whom? In case you are making payment of what? You are making payment of salary, or you are making payment to a non-resident person. In that case, the TDS rate will be equal to the tax rate. Whatever is the tax liability, entire tax amount should be deducted in the form of TDS. In case of other payments, rate of TDS is specified in the relevant section. In case of other payments, rate of TDS is specified in the relevant section. So when we get into those relevant sections, we'll understand this. Point number 8. Along with TDS, should the payer also collect surcharge and cess? Along with TDS, should the payer also collect surcharge and cess? Or these TDS rates which are given in the section are inclusive of surcharge and cess? That is what we need to understand. So I'm giving you 1 minute's time. You can refer this point number 8 very quickly. Refer point number 8 very quickly. I think it is self-explanatory. If you are not able to understand, I'll explain. So should you deduct surcharge and cess along with the TDS rates? Yes, if you are making payment of salary. If you are making payment of salary, then along with basic tax rate, you should deduct the surcharge and cess. On the other hand, if you are making payment, any other payment except salary, other than salary, if you are making payment to whom? To a resident person. So when you are making payment to a resident person, then we should see what is the nature of payment. If you are making payment to a resident person, we should see what is the nature of payment. If the nature of payment is salary, then it should deduct TDS along with surcharge if applicable, and cess, health and education cess should always be deducted. If the person to whom you are making payment is a resident person and the nature of payment is other than salary, then you should only deduct TDS as per the rates given in the section. You should not deduct surcharge, you should not deduct cess. In other words, inside commerce studies is paying me professional fees. On that, they will not deduct surcharge and they will not deduct cess. That surcharge and cess I will have to pay directly to the government. They will not deduct. I can give a numerical example. Listen to me. For example, Ramya madam, for example, your yearly salary is 1 crore. Your yearly salary is 1 crore. What will be the tax liability on 1 crore? Up to 10 lakh tax liability is how much? 1,12,500. Basic tax, I'm talking about basic tax. On tax on an income of 10 lakhs, your basic tax is how much? 1,12,500. On the excess income 90 lakhs, 30% tax. That is 27 lakhs. So what will be your tax liability? 27 lakhs plus 1,12,500. That is 28 lakhs 12,500. Will surcharge apply in this case? Yes, surcharge is definitely applicable. Now the question is, while the employer is paying you salary, should he also deduct surcharge? Or should he only deduct 28 lakh 12,500? He should not deduct surcharge. That is the question. So what is the answer to that? Yes, he should deduct the surcharge. And he should also deduct the cess. So on this 28 lakh 12,500, you will have to apply surcharge also. You will have to apply surcharge also. What is the rate of surcharge? If your income is beyond 50 lakhs up to 1 crore, what is the rate of surcharge? 10%. So you apply that 10% on this 28 lakh 12,500. So to this 28 lakh 12,500, you add 281 to 50. So your amount is 30 lakh 93,750. To this you add 4% cess. To this you add 4% cess. 32 lakh 17,500. So throughout the year, employer is going to pay you a remuneration of 1 crore. Definitely your remuneration will be equally every month. So what employer should do? 32 lakhs 17,500. He should divide it by 12. 32 lakhs 17,500. He will divide by 12. Whatever amount is arrived. How much you are getting? 260 at 125. Okay. So what is your monthly remuneration? If your yearly remuneration is 1 crore, what is your monthly remuneration? 1 crore divided by 12. How much you are getting? 1 crore divided by 12. 8,33,333. So from this 8,33,333, the employer will deduct TDS. How much TDS he will deduct? 260 at 125. He will deduct 260 at 125. Is that very clear? Yes. So what he has deducted? He has deducted basic tax. He has deducted surcharge. He has also deducted cess. So if the payee is a resident person, Ishwar, listen to me carefully. You are working as an employee of a very big company. Your yearly remuneration is 1 crore. So what is your monthly remuneration? Your monthly remuneration will be 1 crore divided by 12 months. So your monthly remuneration will be 8,33,333. From that 8,33,333, how much amount of tax will be deducted? 2,68,125. How do you get this 2,68,125? On an income of 1 crore, you calculate the basic tax. On that you add surcharge. Then take the total of basic tax plus surcharge. Whatever is the total of basic tax plus surcharge, on that you also apply the cess. Whatever final tax liability you are arriving at, that should be divided by 12. Ishwar, understood? Yes. Okay, let us proceed now. Second point, if the payee is a resident person and the payment is any other payment except salary, then surcharge and cess should not be deducted. For example, Inside Commerce Studies is paying me professional fees. I am a resident person. And they are paying professional fees to me. In that case, they should not deduct surcharge, they should not deduct cess. They should not deduct any surcharge and cess. Third point, if the payee is non-resident or foreign company. If the payee is either non-resident or foreign company, in that case, whatever may be the nature of payment, you should always deduct surcharge if applicable, and cess is always applicable, so you should always deduct cess. So when the salary is paid to a resident person or any other payment is done to a non-resident person or foreign company, then surcharge and cess should always be deducted. So when surcharge and cess will not be deducted, when the payment is made to a resident person and the nature of payment is any payment except salary. Any payment except salary. Is that very clear? Yes. Let's move on to point number 9, section 206AA. See, in my example, Inside Commerce Studies is payer, I am paying. They are paying me professional fees. They will deduct my tax, and their duty is to pay this tax to the government. My duty is to provide my PAN number to Inside Commerce Studies. My duty is to provide my PAN number to Inside Commerce Studies. What if I do not provide the PAN number to Inside Commerce Studies? In that case, Inside Commerce Studies should deduct TDS at higher of following rates. If I do not provide the PAN number to Inside Commerce Studies, government believes that what is there to share? PAN number is not a secret number. You should give PAN number to the payer. If you are not giving PAN number to the payer, means there is something wrong going on in your mind. Therefore, in that case, we will ask the payer to deduct TDS at higher of following rates. First is rate in force. Rate in force means whatever is the tax rate. This rate in force will be given in the annual finance act. Rate in force means the tax rate. Second rate is rate prescribed by the Income Tax Act. In Income Tax Act, in every specific section, there will be a rate of TDS. So you compare what is the rate in force, tax rate, compare the TDS rate, and then you also take 20%. Out of these three rates, you select whichever is higher. You select whichever is higher. So, for example, if I do not provide the PAN number to inside commerce studies, then rate prescribed in the Income Tax Act in section 194J is 10%. That they will compare with 20%. What is higher? 20%. So they will deduct my tax at 20%. Have you understood this? Okay. But instead of 20%, you should apply 5% in case of section 194O. That we'll understand when we get into that 194O, not right now. TDS is just one mode of recovery of tax. Besides TDS, government is also having other mechanism to collect the tax. Which are those other mechanism? TCS and advance tax. TCS and advance tax. Point number 11, tax needs to be deducted in case of business as well as personal transaction. Whether the transaction is business transaction or personal transaction will not make any difference. Tax is required to be deducted. Yes, to this statement there is an exception. Section 194C and 194J on personal transaction tax will not be deducted. That we'll discuss when we get into that section. But right now you should just understand that tax is required to be deducted in case of business transaction as well as personal transaction. Next point is no tax should be deducted on GST component. No tax should be deducted on GST component. For example, I am registered with GST. So I will raise a bill on inside commerce studies. Say for example, they are supposed to pay me the professional fees of 1 lakh. On that 1 lakh, I will levy 18% GST. I will levy 18% GST. So they will pay me 1,18,000. While paying me 1,18,000, they are required to deduct tax. Will they deduct tax on 1,18,000 or should they deduct tax only on 1 lakh? Answer is they should deduct tax only on 1 lakh rupees. On GST, they should not deduct tax. Why? Because that GST is not my income. I'm just collecting from them and I'm paying it to the government. I'm collecting that GST from them and I'm paying it to the government. GST is not my income, it is my liability. So out of 1,18,000, what is my income is? Only 1 lakh. On that 1 lakh only, tax is required to be deducted. Is that very clear? Yes or no? Okay, let's move on to the last point. No TDS in case the income is exempt from tax and return is not required to be filed. If your income is totally exempt in some section and you are not also required to file your income tax return, in that case, tax will not be deducted in your case. In that case, tax will not be deducted in your case. So these were the general points which we discussed. Now we need to move on to specific sections. Now before we move on to specific sections, let me tell you that in every specific section, we'll be discussing 8 things. Number 1, what is the section number? Number 2, what is the nature of payment? Number 3, which payer is liable to deduct TDS? See, government cannot ask every payer to deduct TDS. It may happen that some payer is deducting TDS and he is running away with the government's money. So government should have faith on those people. Government should be in a position to rely on these people. Then only government will allow the tax deduction. Pay. Nature of pay means when you should deduct TDS. When the pay is resident, you should deduct TDS, or when the pay is non-resident, then you should deduct TDS, or you should deduct TDS irrespective of the residential status of pay. That is what we'll discuss in this point. So we need to discuss 8 points in every section. Number 1 is section number. Number 2 is nature of payment. Every section is specifying a particular nature of payment. Number 3 is nature of payer. See, every person is not liable to deduct TDS. Government has assigned some duties to specific people. For example, government has said, if you are a business organization, your turnover is more than 1 crore, then only you should deduct TDS. If you are a professional, your gross receipts are more than 50 lakhs, then only you should deduct TDS. Have you understood this? That we'll discuss when we get into the respective section, nature of payer. Nature of pay. Should we deduct TDS in case the pay is resident, or should we deduct TDS in case the pay is non-resident, or should we deduct TDS irrespective of residential status of pay? That is what we'll understand in this point. When to deduct TDS, this point I've already explained you. Some section will say that TDS should be deducted at the time of payment or at the time of crediting pays account, which was earlier. Whereas some section will say that TDS should be deducted at the time of payment. Rate of TDS we need to understand. Minimum amount not liable to TDS. Minimum amount not liable to TDS means every section will prescribe some amount. If the payment does not exceed that particular amount, then tax should not be deducted. For example, in this section we have written less than 50,000. So if you are making payment of less than 50,000, then tax will not be deducted. Tax will be deducted only if you are making a payment of 50,000 or more. Tax will be deducted only if you are making a payment of 50,000 or more. And then we need to discuss certain important points with respect to certain specific sections. Then we need to discuss certain important points with respect to certain specific sections. So now we proceed with respect to discussion of specific sections. And in each section, we are going to discuss 8 points. We'll be discussing 8 points in each of the sections. First section is section 192. Section number is 192. Nature of payment is salary paid to employee. Nature of payment is salary paid to employee. So whenever you pay salary to employee, you should deduct TDS in section 192. Payer is any person. Means every person should deduct TDS, irrespective of whether that person's business turnover is more than 1 crore, less than 1 crore, whether that person is individual, HCA, firm, company. Everyone should deduct TDS on payment of salary. Pay, any person. In other words, irrespective of whether the pay is resident or pay is non-resident, in all cases, you should deduct TDS. In all cases, you should deduct TDS. When to deduct TDS? In case of salary, TDS should be deducted at the time of actual payment. Means when you credit the bank account, at that point of time, TDS should be deducted. In other words, at the end of the year, in the month of March, when you pass an entry, salary account debit to outstanding salary account. When you pass an entry, salary account debit to outstanding salary account, you should not deduct TDS because you are not making payment. Next year, when you pass an entry, outstanding salary account debit to bank account, at that point of time, you should deduct the TDS because TDS is required to be deducted at the time of actual payment of salary. Yes, have you understood this point? Yes or no? We have discussed 5 points. Section number, nature of payment, nature of payer, nature of pay, when to deduct TDS. Next is rate of TDS. TDS should be deducted at what rate? In case of salary, TDS needs to be deducted at slab rates. How TDS will be calculated on slab rates? That is what I explained a few minutes back, saying that Your salary is 1 crore. What is the tax liability on 1 crore? You calculate the basic tax. On that, you apply the surcharge if applicable. On that, you apply the cess. Whatever tax amount is arrived, divide that amount by 12. Divide that amount by 12 and deduct the tax. So here, in case of salary, we are saying that tax should be deducted at which rate? Slab rate. Minimum amount not liable to TDS. Minimum amount not liable to TDS. Tax is not required to be deducted if the tax liability on the salary income after deduction and rebate is zero. If the salary income is zero, say for example, salary is up to 20,000 per month. So yearly salary will be 2,40,000, which is less than the basic exemption limit. Then we should not deduct TDS. Forget about forget about 20,000. Even if salary is 40,000, then yearly amount would be 4,80,000. On 4,80,000, definitely there will be a tax liability, but you also have a rebate under Section 87A. If your total income is less than equal to 5 lakhs, you are a resident, you are individual, then you enjoy a rebate of 12,500. And your tax liability after rebate will be zero. In that case, employer should not deduct TDS. In that case, employer should not deduct TDS. Have you understood this? Yes or no? Okay, let's move on to the last point. Other important points. Other important points with respect to deducting tax in case of salary payment. Whenever you are making payment of salary, you should deduct TDS, and you should keep in mind this following point. Number one, no TDS if the taxable salary is less than or equal to basic exemption. That I have already explained you. Forget about basic exemption limit. If the tax liability is zero, even after rebate under Section 87A, then also TDS is not required to be deducted. Next, in this section, tax is required to be deducted only at the time of actual payment. In this section, tax is required to be deducted only at the time of actual payment. Yes, Deva madam, if your salary is up to 5 lakh per annum, tax will not be deducted. If your salary is up to 5 lakh per annum, tax will not be deducted because your tax liability will be zero. TDS should be deducted in this section only at the time of actual payment. So on outstanding salary, TDS will not be deducted. TDS will be deducted only when you pay the salary. That is when you credit the bank account. The word salary will include everything. It will include basic salary, allowances, monetary perquisite, non-monetary perquisite, advance salary, arrears salary, bonus, everything will be included in salary. Exemption, rebate, relief, deduction should be taken into account. So while you calculate the tax liability, while you calculate the TDS, for that you have to calculate the tax liability. For calculating the TDS in this chapter, in this section 192, TDS on salary, if you have to calculate, then you have to calculate the tax at slab rate. For that, if some exemptions are available like house rent allowance exemption, you provide the exemption. If some relief is available under Section 89(1), relief with respect to arrears of salary, etc., or some deduction is available like standard deduction for entertainment allowance, profession tax, we should provide all those deductions. So tax should be deducted after providing exemption, relief, rebate, deduction, etc. Next is simultaneous employment. Simultaneous employment. I'll take one example to make you understand this point. Can you see the example on the screen? Okay. Now, for example, Ishwar has completed his chartered accountancy. Ishwar has completed his CA, and now he is working with a college. Morning time, the morning 7 to 10:30, he is working with a college, and his remuneration from college is 6 lakhs per annum. Thereafter, from 12 o'clock onwards, from 12 to late evening, 9 p.m., he is working with a company. He is working as an employee of the company. There also his remuneration is 6 lakhs per annum. So college is paying him a remuneration of 6 lakhs per annum. Company is also paying him a remuneration of 6 lakhs per annum. So Ishwar is doing two jobs simultaneously. Ishwar is doing two jobs simultaneously. Morning he is working with college, then he is working with company as an accountant. Then definitely both will deduct TDS, na? College will deduct TDS, company will also deduct TDS. Yes or no? How much TDS college will deduct? They will calculate the tax liability on 6 lakhs. What will be the tax liability on 6 lakhs? Please calculate very fast. Yes. What is the tax liability on 6 lakhs? Up to 5 lakh, 12 tax liability is 12,500. On that excess 1 lakh, tax liability will be 20%, that is 20,000. So tax liability, basic tax liability will be 32,500. Surcharge will not be applicable here because income is not exceeding 50 lakhs. Surcharge will not apply here. Cess will apply. So you apply cess on this 30 to 500. You apply cess on this 30 to 500. We'll get the amount of 33,800. This 33,800 should be divided by 12. This 33,800 should be divided by 12. So 2817, you get the amount of 2817. So college will go on deducting 2817 every month. Every month, college will go on deducting 2817. Company will also go on deducting 2817 because company is also paying the same amount of remuneration. Now my question is, throughout the year, how much amount college will deduct? College will deduct 33,800. Company will also deduct 33,800. So what is the total of both? 67,600. 67,600 is the total of both. Correct? Yes or no? So basically, I'm trying to tell you that at the beginning of every financial year, employer will estimate your tax liability. Employer will make the estimated salary income statement. On that estimated salary income statement, he will calculate the tax on estimated basis. Whatever is the amount of tax, he will divide that by 12, and he will go on deducting equal amount from your salary. He will go on deducting equal amount from your salary. Now, if he deducts, say 33,800, if college deducts 33,800 from your salary throughout the year, and company also deducts 33,800, then throughout the year they will deduct how much? They both together will deduct how much? 67,600. But can you tell me what will be your tax liability? You are getting an income of 6 lakh from college, and you are getting a income of 6 lakhs from company. So your total income is how much? 12 lakhs. What will be the tax liability on 12 lakhs? Can you calculate very quickly? 179,400. Akash, you should add 4% cess also. 170 and 400. Now, if you look carefully, then your actual tax liability is 179,400, whereas tax which is deducted by both the employers combined is only 67,600. Why so? Because they do not know that you are also working with someone else. Because they do not know that you are also working with someone else. They have deducted TDS as if you are working with them only, on the assumption that you don't have any other income. But this is not a fact. The fact is you are working, you are doing one more job. There also you are getting a remuneration. So in this case, your actual tax liability is more than the TDS amount. In that case, the differential amount, 170 and 400 minus 67, 600, you will have to pay directly to the government. The differential amount you will have to pay directly to the government. If you don't want to get into these difficulties, if you don't want to get into the difficulty or headache of this payment of tax directly to the government, what you can do now? You can submit form number 12B to any of the employer. You can submit form number 12B to any of the employer. Now here I am telling you that form number 12B is submitted to the company in July. Form number 12B is submitted by employee issuer to the company in the month of July. So in the month of July, when company has received form number 12B, form number 12B will mention what? Form number 12B will contain what? It will contain salary from college, monthly salary from college is how much? 50,000. Tax deducted by college is 2817 per month. This is what will be written in form number 12B. And this form number 12 is submitted to the company. In that case, company will estimate the entire year's salary income. Company will estimate entire year's salary income. See, this is the way. On which date this is submitted? 1st July. 1st July. So what will happen? On 1st July, company will make this statement. Estimated salary income statement on 1st July. Salary from college is 6 lakhs, salary from company 6 lakhs, total is 12 lakhs. On that tax liability is 179,400. On that tax liability is 179,400. Now, this data is submitted now. This information is given to company in which month? In the month of July. Means already 3 months are gone now. Already 3 months are gone. During those 3 months, college might have already deducted tax at the rate of 2871 per month multiplied by 3 months. That is 8451. During these 3 months, company also might have deducted tax at the rate of 2817 for 3 months. That is 8451. Even after you submit this information to the company, even after you submit form number 12B to the company, college will still deduct 2817 per month for the next 9 months. That is from July to March. That is from July to March. College will go on deducting 2817 for 9 months. So you deduct all these amounts. And what is the balance tax? From 179,400, you deduct all these amounts. From 179,400, you deduct 8451, and 25,353. If you deduct 3 amounts, you will arrive at an amount of 145,596. Then this 145,596 will be divided by 12. Will be divided by 9. What is 9? This is nothing but balance number of months left in a year. Out of 12 months, 3 months are already expired. So now only 9 months are left. So this will be divided by 9 months, and the amount of 16,177 is arrived. Amount of 16,177 is arrived. So your company will now start deducting tax at the rate of 16,177 per month. If company deducts the tax at the rate of 16,177 per month for the next 9 months, then combined tax deducted by the college and the company throughout the year would be 117,400. In other words, in that case, you will not be liable to pay any tax to the government because your entire tax is deducted in the form of TDS. Have you understood this? Yes or no? So this was the example for what? Example for simultaneous employment. The example was for simultaneous employment. Now I'll take one more example for successive employment. Successive employment. Which tax liability on 12x is how much? 179,400. Say for example, your monthly salary equals to 50,000. Can you tell me what will be the amount of tax will be? How much tax will be deducted? Tax to be deducted. How much? 2817, correct? Same number I am taking. Now say for example you have worked with employees Reliance Industries Limited. Your monthly salary is 50,000. Tax to be deducted is 2817 per month. 2817 per month. Now say for example, employee resigned from Reliance Industries Limited. And joined Tata Steel with effect from 1st October. What will happen in this case? In this case, if you don't, say for example, at salary of 75,000 per month. In this case, if you don't provide the details with respect to how much salary you have earned from Reliance in the past, in that case, what Tata Steel will do? Tata Steel will deduct tax on what amount? You will deduct tax only on Dikshit. How did you get this 158,600? 1,12,500 plus 50,000. Which is 170 and 400 is correct. Are you understanding what I am trying to explain you? Yes or no? Yes. So I have now taken another example to make you understand what would be the manner of tax deduction in case of successive employment. Successive employment means you are working with one company, now you have resigned from that company and you have joined some other company. So here I have given you example. Your employer is Reliance Industries, your monthly salary is 50,000 per month. In that case, your tax to be deducted will be 2,870 rupees per month. Now the employee has resigned from Reliance Industries Limited and he has joined Tata Steel Limited with effect from 1st October 20 at a salary of 75,000 per month. In that case, if you don't provide details of your salary from Reliance to Tata Steel, in that case, what they will do now? They will take up your salary as 75,000 per month for 6 months. They will take up your salary at the rate of 75,000 per month for 6 months, that is from October to March. So they will say that your salary is 4,50,000. Your income is only 4,50,000. On that 4,50,000, they will calculate the tax liability, and because of rebate under section 87A, the tax liability will be 0 and they will not deduct any tax. But this is not correct now, because your tax liability is not 0. They are getting the tax liability as 0 because you have not provided the details of salary which you have received from Reliance. So in case of successive employment, you should submit form number 12B. Employee should submit form number 12B to Tata Steel. The form number 12B will include what? Details of monthly salary and tax deducted. Giving details of monthly salary and tax already deducted. Yes. So what will happen? On 1st October 20, Tata Steel will make a new statement. The moment you submit the details in form number 12B, the moment you join the Tata Steel on 1st October, you submit form number 12B. They will make an estimated salary income statement on 1st October 20. In that they will write salary from old employees 50,000 per month multiplied by 6 months. That is 3 lakhs. Then they will write salary from new employer 75,000 per month multiplied by 6 months. That is 4,50,000. So our total salary is 7,50,000. On that above 7,50,000, they will deduct TDS. On that 7,50,000, they will deduct TDS. For that, they need to calculate the tax liability. So can you tell me what will be the tax liability on this 7,50,000? Up to 5 lakh tax liability is 12,500. Above 5 lakh, on that remaining 2,50,000, tax will be 50,000. So that will be 62,500 plus 4% cess. So the tax will be 65,000. Reliance has deducted how much tax during the first 6 months? Reliance has deducted tax at the rate of 2817 for 6 months. That is, they have deducted 16,902. They have deducted 16,902. Okay. So what is the balance tax payable? 65,000 minus 16,902. Balance is 48,098. This 48,098, your new employer will deduct equally over a period of 6 months. So he would deduct how much? 8016 every month. 8016 every month. Have you understood this? Yes. So I have taken numerical examples and I have explained you two things. How these TDS provisions will work in case of simultaneous employment, how it will work in case of successive employment. See, till now, whatever we discussed, that is how much amount of tax your employer will deduct in case of salary income. Do you think if employer deducts the adequate tax on salary income, your tax liability will be zero? Definitely not. Why? Because you might be having some other income also. You might be having income under capital gains, income under other sources. You can have income from house property. Therefore, we say that. Therefore, we say that you have an option to furnish the details of other income to your employer. If you don't furnish the details of other incomes to your employer, then what will happen now? On that other income, you have to pay tax directly to the government. If you don't want to get into the headache of paying tax directly to the government, then you can provide the details of other income to your employer. You can pick up a piece of paper. On that, you can write my income from house property amount is this much. My other source of income is this much. My capital gain is this much. I'm going to take this much amount of chapter 6 reduction. All these things you can write on a piece of paper and submit to your employer. The moment you submit this to your employer, what employer will do now? Employer will calculate your estimated total income. Employer will make a estimated total income statement. Till now he was just making estimated salary income statement. Now he will make estimated total income statement. But very important point is, if you have given the details of other income to your employer, if you have given the details of other income to your employer, that details might have losses also, no? Details of losses. You might have incurred some loss under IFSP. You might be having some loss under capital gain. You might have some loss under PCBP. So question is, should your employer consider all these losses? Answer is no. He should not consider all losses. He should consider only one loss, that is loss under IFSP. He should consider only one loss, that is loss under IFSP. In other words, when you provide the details of other income to your employer, you can even provide the details of your losses. If you are providing the details of losses to your employer, employer should ignore all other losses. He should consider only the house property loss. Whatever loss is there under that income from house property, that employer should take into account while calculating the estimated total income. Thereafter, whatever exemption, deduction, set off of loss, etc., you are claiming, for that your employer should collect the adequate evidence. Employer should collect adequate evidence. For example, you are claiming exemption with respect to house rent allowance. You are claiming exemption under section 10 clause 13A with respect to house rent allowance. In that case, your employer should collect the rent receipt from you. That rent receipt will clearly mention how much amount of rent you have paid. So he should collect the rent receipt. If you are claiming deduction under section 80C with respect to investment, then whatever investment you have made, for that you should submit the evidence to your employer. Then only he should take into account the exemption, deduction, etc. If you are not submitting the evidence, then he should not take into account the exemption and deductions. Have you understood this? So, in point number G, H, and I have explained you that generally employer will deduct TDS only on salary income, TDS on other income, tax on other income you will have to pay directly to the government. If at all you don't want to get into the headache of paying directly tax to the government, you can provide the details of your other income to your employer. In that case, employer will make the estimated total income statement. If you have provided the details of losses also along with the details of other income to the employer, then employer should take into account loss only under the head income from house property. All other losses he should totally ignore. Thereafter, if you have claimed any exemption, deduction, etc., then employer should collect the evidence or proof of that exemption deduction. Then only he should grant you exemption deduction. Accordingly, you should calculate the tax liability, and that tax liability should be deducted equally over the balance period. That should be deducted equally over the balance period. If you are eligible for relief under section 1891, do you remember relief? Salary chapter I had taught you relief in the last question. Last question we had solved relief na? Relief in case of arrears of salary. Do you remember that? Yes, okay. So if you are eligible for relief, then you fill up form number 10E. If you are eligible for relief, then you fill up form number 12E, sorry 10E, and submit to the employer. Employer will calculate the relief and he will deduct the amount of relief from your tax liability. Accordingly, he will provide you relief and deduct lower tax. Adjustment in the TDS. For example, by mistake, employer has deducted less TDS in the month of March. Can he deduct more TDS in the month of, employer by mistake has deducted less TDS in the month of say June. Can he deduct more TDS in the next month, subsequent months, in the month of July, August, etc., to compensate the lower tax deducted in the past month? Answer is yes. If employer has deducted less tax in the past month, to compensate that, he can deduct more tax in the subsequent month. If employer has deducted more tax in the past month, then he has to accordingly deduct less tax in the subsequent month. So adjustment of that TDS amount is allowed to the employer. Next point is every employer should give a TDS certificate to employee. Every employer should give what? TDS certificate to employee. See, at the beginning only I told you that there are 4 duties of payer. Number 1, deduct tax. Number 2, pay tax. Number 3, file the TDS return. And number 4, issue the TDS certificate. So the payer should issue TDS certificate to the payee. Employer should issue TDS certificate to employee in form number 16. This form number 16 na, is a TDS certificate for payment of salary. In this form number 16, it will be clearly written how much amount of salary your employer has paid to you, what is the amount of basic salary, what is the different allowances, what is the perquisite, what is the gross salary, deductions, everything will be written in detail. Along with the TDS certificate in form number 16, employer should also give you the statement of perquisites of profiting of salary. This statement should be given in form number 12BA. This statement is required to be given only if the employee's salary income is more than 2,50,000. This statement is required to be given only if the employee's salary income is more than how much? 2,50,000. More than 2,50,000. Is that very, very clear? Okay. So employer should issue TDS certificate in form number 16. He should issue a statement of perquisites and profits in lieu of salary along with form number 16. This statement is also required to be issued in form number 12BA. But this is required to be issued only if yearly salary is more than 2,50,000. If yearly salary does not exceed 2,50,000, then such details can be given in form number 16 itself. Then such details can be given in form number 16 itself. Have you understood this? See, this is one point which I might have explained you in the chapter of PGVP. I do not remember. I do not remember whether I explained you or not. If not, I am explaining right now. Here there is an employer. Employer has provided perquisites to employee. The perquisites which employer is providing to employee can be either a monetary perquisite or it can be a non-monetary perquisite. Monetary perquisite means those which are covered by section 17 to clause 4, 5, 7 and 7A. Rest all are non-monetary perquisite. 17 to clause 1 rent-free accommodation, clause 2 concession accommodation, clause 3 perquisite provided to specified employee, clause 6 ESOPs, clause 8 fringe benefits, all these are non-monetary perquisite. Now say for example, employer has agreed to pay employees tax on this perquisite to the government. Ideally what employer should do? Ideally employer should deduct TDS from employee's salary and pay to the government. But here I am saying you that employer has agreed with the employee to pay the tax on this perquisite out of his own pocket without deducting from employee's salary. The employer has decided that on this perquisite, I will not deduct TDS. I will pay tax on this perquisite from my own pocket. So say for example, a monetary perquisite is provided to employee. For example, employer has paid your life insurance premium. Employer has paid your life insurance premium. If employer has paid your life insurance premium, that is a monetary perquisite. That monetary perquisite is taxable to you as per section 17 subsection 2 clause 5. Tax on that monetary perquisite works out to say 20,000 rupees. For example, you are following to 20% slab rate and the employer has paid 1 lakh insurance premium to the insurance company on your behalf. Then because of that your tax liability will increase by 20,000. That 20,000 employer should deduct from your salary and pay to the government. But instead employer has decided to pay that amount from his own pocket. Employer has decided to pay that amount from his own pocket. In that case, whatever tax is paid by employer on your behalf is an expenditure for the employer. He will claim deduction in section 10, or he will claim deduction in section 37 subsection 1 while computing his business income. And whatever tax is paid by employer, that tax paid by employer is also considered as your income because it was your obligation which is paid by employer. So employees income tax, employees profession tax, etc. If that is paid by employer, then it is considered as obligation of employee met by employer. That amount of tax will also be added to employee's income. That amount of tax will be added to employee's income and that amount of tax will be taxable. So there will be a tax on tax. So I am just giving an example saying that employer has paid a life insurance premium of say 1 lakh rupees. On that 1 lakh, your tax liability works out to say 20,000. That 20,000 ideally employer should deduct from your salary and pay to the government. But instead of that, employer has paid that 20,000 from his own pocket. In that case, what treatment should be given to this 20,000? Here we are not having discussion on perquisite. We are discussing tax on perquisite. We are discussing a situation wherein the tax on perquisite is paid by employer from his own pocket. So in our example, if employer has paid 20,000 tax on life insurance premium, then that 20,000 employer will debit his profit and loss account and he can claim deduction. Deduction will be allowed in section 37 subsection 1. And that same 20,000 will be added to employee's income. That same 20,000 will be added to employee's income and tax will be levied in section 17 subsection 2 clause 4. This 20,000 will be added to employee's income because of section 17 to clause 4. This 20,000 will be added to employee's income because of section 17 subsection 2 clause 4. Have you understood this? Yes or no? Are you getting my voice? Deva madam is saying, sir, won't it be a double taxation? So my question to you is, don't you feel it is a double advantage to you? Instead of double taxation, you should think about double advantage. Your tax, employer should deduct from your salary and pay to the government. Instead of employer deducting that amount from your salary and then paying to the government, he is paying from his own pocket. If employer is paying your tax from his own pocket, don't you think that you have received the advantage? That is the reason that amount is added to your salary. Instead of employer paying your tax, if employer gives you 20,000 extra, then also that 20,000 will be added to your salary, na? Say for example, instead of employer paying your tax, he gives you 20,000 extra, saying that you pay this to the government. In that case, also that 20,000 will be added to your salary. Deduction under section 80C will be allowed. That is what we have already discussed in deduction chapter. Even if employer has paid the LIC premium, life insurance premium for employee, that premium will be added to employee's income, and for that employee can claim deduction under section 80C. Now shall I move on to the right hand side? Listen to me carefully now. Say for example, employer has provided you rent-free accommodation. Employer has provided you rent-free accommodation to stay. Value of that accommodation as per rule 3. Do you remember rule 3? Unfurnished accommodation, furnished accommodation, hotel accommodation. You have to do the valuation. So if employer has provided you rent-free accommodation to stay, you have to ascertain the taxable value of procured as per section 17 subsection 2 clause 1 read with rule 3 sub rule 7 clause 1. The procured value is ascertained at 2 lakh rupees. What should happen about this 2 lakhs? This 2 lakhs should be added to your salary income and tax should be levied. This procured value of 2 lakhs should be added to your salary income. On that, employer should deduct tax and pay to the government. Instead of employer deducting tax from your salary, he has decided to pay tax on that from his own pocket. So what is the value of this rent-free accommodation? Procured value is 2 lakhs. On that, tax arrives at say 40,000 rupees. On that, tax amount is say 40,000 rupees. So employer should ideally deduct 40,000 from your salary and pay to the government. But instead he has paid this tax from his own pocket. But instead he has paid this tax of 40,000 from his own pocket. This tax is an expenditure for your employer. This tax paid by employer on non-monetary perquisite provided to employee is an expenditure for the employer. Since it is an expenditure for the employer, he will ask for deduction. But in the chapter of PGBP, we have section 40 clause A subclause 5, which says that deduction will not be allowed. Which says that deduction will not be allowed. Employer has provided you rent-free accommodation. On that, tax amount arrives at 40,000 rupees. That 40,000 employer has paid from his own pocket to the government. So he is going to debit the profit and loss account by this 40,000. He will claim deduction for that 40,000. But section 40 clause subclause 5 says that 40,000 will not be allowed as deduction. In other words, while computing business income of employer, you should add back this 40,000 to his income. In other words, on that 40,000, employer himself has to pay the tax. That 40,000 tax is paid by employer from his own pocket to the government. That is an advantage received by you. That is a benefit received by you. Ideally, it should be taxable to you. That 40,000 should be added to your salary income and tax should be levied as per section 17 subsection 2 clause 4. Obligation of employment by employer. But in the chapter of salary itself, we are having one section, section 10 clause 10 double C. Section 10 clause 10 double C. Because of this section, the entire 40,000 will be exempt from tax. Entire 40,000 will be exempt from tax. Have you understood this? Yes or no? Sarvana, I will repeat. But this chapter requires a lot of focus because there is huge amount of theory. And if I go on repeating every time, then this chapter will consume 4 or 5 days. Because it is full of theory and there is a lot of theory. I am repeating once again. Listen to me very carefully. Say for example, I am employer, you are employee. I am employer, you are my employee. I am giving you rent-free accommodation to stay. So whatever is the taxable value of per quid of that rent-free accommodation, that should be ascertained. As per section 17 subsection 2 clause 1, taxable value of per quid is, say for example, 2 lakhs. What should happen with respect to that 2 lakhs? That 2 lakhs should be added to your income and tax should be levied. So on that 2 lakhs, I should deduct TDS, correct? On that 2 lakhs, since it is taxable, I as an employer should deduct TDS and I should pay this TDS to government. In your case, TDS works out to 40,000 rupees. So I should deduct 40,000 from your salary and I should pay this 40,000 to the government. Instead of that, I have agreed to pay that 40,000 from my own pocket to the government. So I have paid 40,000 from my own pocket. We are not discussing perquisite here. We are discussing tax on perquisite. So our focus is on 40,000, not on 2 lakhs. That 40,000 I have paid to the government on your behalf. That 40,000 is an expenditure for you. I have debited my profit and loss account to claim the deduction. But government says deduction will not be allowed. Where it is written? In the chapter of PGVP, government has inserted section 40 clause A subclause 5. In that, government says that amount of tax which is paid by employer on the non-monetary perquisite provided to employee, that will not be allowed as deduction to the employer. And the amount of tax which I have paid on your behalf, ideally it should be considered as your income. Ideally, it should be considered as your income. But government says you can consider that as income as per 17(2) clause 4, but it is exempt in section 10 clause 10 double C. So that 40,000 will not be added to your salary and once again tax will not be levied to you on that 40,000. Sarvana, have you understood? So what is going to happen now? In case of this monetary perquisite now, your employer has paid a life insurance premium of 1 lakh on your behalf. On that tax amount is 20,000. That 20,000 is a tax on monetary perquisite. That employer will debit his profit and loss account. Correct, correct. On that 40,000, tax will not be levied because that 40,000 is exempt in section 10 clause 10 double C. Yes. I am repeating once again. Listen to me very carefully. Employer has paid your life insurance premium. On that tax amount turns out to 20,000. That 20,000 employer has paid from his own pocket. That 20,000 he will debit to his profit and loss account, and that 20,000 will be added to your income. That 20,000 is added to your income will once again increase. If employer agrees to pay tax even on that incremental amount of income, then once again he will pay tax from his own pocket. He will debit profit and loss account claim deduction, and that tax paid by employer on your behalf to the government, that will once again be added to your income. So this vicious circle will go on in case of monetary perquisite. In case of monetary perquisite, again and again this vicious circle will go on till the time employer is paying taxes. But that is not going to happen in case of non-monetary perquisite. Because in case of non-monetary perquisite, at the first instance only, when the employer pays the tax on non-monetary perquisite to government, that is not added to your income. That is exempt in section 10 clause 10C. And that is disallowed to the employer. Is that very, very clear? Yes or no? So let's quickly now refer to point number N. Tax on non-monetary perquisite borne by employer. Tax on non-monetary perquisite borne by employer. In that case, if employer has agreed to pay tax on non-monetary perquisite, in that case, tax will not be deducted from salary. Tax will be paid by employer from his own pocket. This tax will be calculated at the average rate of tax. How much tax employer will pay from his own pocket now? On the amount of perquisite value of 2 lakhs, he will apply the average rate of tax. Now, what is this average rate? That we have discussed in the chapter of basic concept. Average rate is nothing but total tax liability upon total income into 100. Average rate is nothing but total tax liability upon total income into 100. For example, your average rate is 20%. So on that 2 lakh rupees, which is the perquisite value of rent-free accommodation, on that employer will apply the average rate, which is 20%. 40,000 he will pay from his own pocket. No deduction to the employer for such tax amount, and this is exempt in the hands of employer. Is that very clear? Let's move on to point number O. Next point, tax on non-monetary perquisite borne by employer is deemed to be TDS. So employer has paid how much tax on your behalf? He has paid 40,000 tax on your behalf. Can you claim that TDS credit? See, whatever TDS people are deducting while making payment of income to you, you already know that what will be taken into your income is gross income. For example, you have received a payment of, for example, inside commerce studies is supposed to pay me 50,000. From that, they will deduct how much? 5,000. And they will pay 45,000 to me. While I compute my income, how much amount I should take into my income? I have received 45 after deducting 5,000. While I compute my income, how much amount should be taken as my income? I should take gross amount or net amount? Definitely I should take the gross amount. This is what is already taught to you in the chapter of income from salary itself. So this logic is not applicable only to salary chapter, it is applicable to every chapter. Whenever you receive amount after deducting TDS, what you should consider in your income is amount before TDS. You should consider in your income is amount before TDS. So I will consider 50,000 in my income. I will calculate total income. On that, I will calculate tax liability. From that tax liability, whatever TDS inside commerce studies have deducted, that amount I will minus. From my total tax liability, I will get the TDS credit, and the balance tax I will pay to the government. So, tax on non-monetary perquisite which is paid by employer, for that can employee claim the TDS credit? Yes, he can claim the TDS credit. Have you understood this point? Yes or no? You should quickly respond. There are only two possibilities. Either you have understood or you have not understood. If you have not understood, drop the message not understood. Simple. Let's move on to the last point. Last point. TDS on shares of securities issued under ESOPs by eligible startup referred to in Section 80 ISA. Have you read this point somewhere else? Just a few minutes back, we read this point in the direct payment. So, if the employer has issued or allotted shares of securities to employee under ESOP scheme, then he should deduct TDS within 14 days from the expiry of 48 months from the end of relevant assessment year, or from the date of sale of ESOP, or from the date on which the taxpayer ceases to be employee, whichever is earlier. He has to calculate 3 dates. Out of 3 days, he has to find out which is the earliest date. From that date, within 14 days, employer should deduct the TDS and pay to the government. If employer has not deducted TDS, then employee should pay tax amount to the government directly within that same period. Have you understood why this is written in two places? Have you understood? Here they are asking employer to deduct the tax. And if employer has forgot to deduct the tax, then in section 191, they are asking the employee to directly pay tax to the government. So here they are asking employee to directly make the payment to the government. This point will be applicable only if the tax is not deducted by employer. If employer has forgot to deduct the tax, then employee will apply the same points, same provisions, and within same 14 days, he will pay this tax to the government. Is that very, very clear? Deva madam, I can give the example if you want. For example, this is the previous year 2021. This is previous year 2021. In this previous year 2021, employer has offered the shares under the ESOP scheme to the employee, and these shares are allotted on 30th September. These shares are allotted to employee on 30th September. Ideally, what happens? As per section 17, subsection 2, clause 6, which is taught to you in the chapter of income from salary, ideally what happens? Tax is levied in the year of allotment. So tax will be levied in the year 2021. So employer should deduct TDS in the year 2021 and pay to the government. But in case your employer is a eligible startup company, then government says we will postpone the collection of tax. This is applicable only in case of eligible startup company. Government will postpone the collection of tax. Shares are allotted on 30th September 20. 30th September 20 falls in the financial year 2021. Financial year 2021 will end on 31st March 21. Financial year 2021 will end on which date? 31st March 21. Dikshit, yes. Let us first of all give this example and complete. I am just giving one example on this point and then we can have a break. For example, company has allotted shares to employee on 30th September 20. So ideally, during the financial year 2021, employer should deduct TDS and pay to the government, because the taxability arises in the year of allotment. But here, the government has come out with an amendment in budget 2020 saying that in case of eligible startup company, we are postponing the collection of tax. So they are postponing the collection of tax in future period. So in that case, what will happen? First of all, you tell me what is your previous year in which the shares are allotted? 2021. What is the corresponding assessment year? 21-22. 21, 22 will end on which date? 31st March 22. From that 31st March 22, you take 4 years period. That will be 31st March 23, 24, 25, 26. So you have arrived at a date of 31st March 26. From that 31st March 26, you take 14 days. That will be 14th April 26. That will be 14th April 26. So employer should deduct tax by 14th April 26 and pay to the government. But ideally, you have to calculate all these 3 dates. Huh? Ideally, you have to calculate all these 3 dates. I have given an example, take into consideration only the first date because you asked me that only. Otherwise, before these 48 months, if the employee has already sold the ESOP shares or employee has resigned from the company, then you should take 14 days from the date of sale or from the date on which employee has resigned. Then you should see whichever is earlier date and accordingly you should deduct the TDS and pay to the government. Deva madam, is that very clear? Can you see section 192A on the screen? 192A. Okay. So let us move on to section 192A. So today before the break, we have completed the section 192 and we also had a background with respect to TDS, TCS advanced tax. 3 different mechanism of collecting tax. In TDS, I explained you that we'll be discussing 8 broad points in every section. And then we started the discussion of section 192, that is TDS on salary income. Next is section 192A. Section number is section 192A. Nature of payment is premature taxable withdrawal from recognized provident fund. Do you remember that income from salary chapter I had taught you recognized provident fund? In case of recognized provident fund, amount withdrawn by the employee at the time of retirement is exempt from tax, provided one condition is fulfilled. Employee should have rendered services for 5 continuous years. If employee has rendered services for 5 continuous years, then amount withdrawn by the employee from the recognized provident fund is exempt from tax. What if employee has not rendered services for 5 continuous years and is withdrawing money? In that case, amount withdrawn will become taxable. And therefore there is a question of deducting TDS. So question of deducting TDS arises only if condition of 5 continuous years of service is not fulfilled. Question of deducting tax arises only if the condition of 5 continuous years of service is not fulfilled. So section 192A, nature of payment is TDS on premature withdrawal from recognized provident fund. What do you mean by premature withdrawal? Premature withdrawal means before completing 5 years of continuous service, you have withdrawn money from the provident fund. So that will become taxable to you. Therefore, tax is required to be deducted. So section number is 192A, nature of payment is premature withdrawal from recognized provident fund account. Who will pay money to whom? Trustee of the employee provident fund scheme will pay money to the employee. That employee can be a resident person or non-resident person, it does not make any difference. TDS is required to be deducted. When TDS is required to be deducted? TDS is required to be deducted at the time of actual payment. In section 192 as well as section 192A, TDS is required to be deducted at the time of actual payment only. What is the rate of TDS? 10%. Since section 192 we said that TDS should be deducted at slab rates. Here we are saying that tax should be deducted at 10%. Minimum amount not liable to TDS is 50,000 rupees. Less than 50,000. So if you are withdrawing an amount which is 50,000 or more, then only TDS will be deducted. Less than 50,000, no TDS. If the amount withdrawn is less than 50,000, no TDS. Other important point, before the break, we also completed section 206 AA. Section 206 AA says what? If the payee does not submit the PAN number to the payer, then payer should deduct TDS at higher of the following rates. Number one, rates in force. Number two, rate given in the Income Tax Act. And number three, 20%. Which one is higher? That point is not applicable in case of section 192A. Why not? Because in section 192A, we are saying that if the payee does not submit the PAN number to the payer, then payer should deduct TDS at maximum marginal rate. Then payer should deduct TDS at what rate? Maximum marginal rate. Do you understand maximum marginal rate? In the chapter of basic concept, I had taught you maximum marginal rate. Maximum marginal rate is nothing but the highest tax rate in case of individual, that is 30%, plus to that highest rate of surcharge, that is 37%, plus to that 4% cess. So that will give you something like 42,744. So tax should be deducted at 42,744% in case the employee does not submit the PAN number. That is written here in point number A. Point number B, they have written TDS should be deducted only when the amount is taxable. When amount is taxable, continuous service of 5 years or more, this condition is not fulfilled. But if 5 years or more continuous service condition is not fulfilled beyond the control of employee due to employee's ill health or discontinuation of employer's business or any other reason which is beyond the control of employee, in that case, that amount withdrawn will not become taxable. Whenever amount is not taxable, there is no question of deducting TDS. Question of deducting TDS will arise only if the amount is taxable. If you transfer balance in RPF from old employer to new employer, then nothing will become taxable because amount is not withdrawn only. If RPF balance is invested in pension scheme, if RPF balance is invested in pension scheme, then nothing will become taxable. No tax on it. Have you understood this? Yes. Yes or no? So you can refer this from summary notes only. You can refer this from summary notes. Section 193 TDS from interest on securities. What do you mean by interest on securities? The word securities will include interest on securities will include number one, interest on debentures, number two, interest on bonds, number three, interest on government securities, etc. Section is 193. Nature of payment is interest on securities. Payer is any person responsible for paying interest on securities. Who will pay interest on securities? If it is a government securities, government will pay interest. If it is bonds or debentures, then the issuer company or issuer financial institution will pay interest on securities. Pay any resident person. What if the pay is non-resident? If pay is non-resident, then TDS will not be deducted in this section. Whenever any section is made specifically for deducting TDS when the payment is made to resident person, then if same payment is made to non-resident person, then that section will not apply. In place of that, you can go to section 195 and deduct TDS. So you can go to section 195 and deduct TDS. So if you are making payment of interest on securities to a non-resident person, non-resident payee, in that case you can deduct TDS in section 195. This section will be applicable only when the payee is a resident person. When to deduct TDS? In section 192 and section 192A. TDS was being deducted at the time of actual payment of salary. TDS was being deducted at the time of actual payment of salary. Whereas in case of interest on securities, TDS needs to be deducted at the time of crediting pays account or at the time of payment, whichever is earlier. Either when you credit the pays account or when you credit the bank account, whichever is earlier. On that earliest occasion, you should deduct the TDS. On that earliest occasion, you should deduct the TDS. Yes, have you understood this? I have already explained you this by passing journal entries. So TDS should be deducted at the time of payment or at the time of crediting pays account, whichever is earlier. What is the rate of TDS? 10%. But because of COVID, in a lot of places, government has reduced the TDS rate by 25%. So instead of 10%, you remove 25% of 10%, that is 2.5%. So government says deduct TDS at the rate of 7.5% if the payment is made during 14th May 20 to 31st March 21. If the payment is made during 14th May 20 to 31st March 21, then instead of 10%, TDS rate at the rate of 7.5% would be made applicable. But if the payment is made from 1st April 20 to 13th May 20, then TDS will be at the rate of 10%. Minimum amount not liable to TDS is 0. So irrespective of whatever amount of interest on securities is paid, you should deduct TDS. Now let's move on to last point, that is other important points. This point number A will refer on later after some time. First of all, let us quickly refer point number B to point number I. No TDS on 4.5% National Defense Bond 1972. 4.5% National Defense Bond 1972. 4.5% National Defense Loan 1968. 4.34% Defense Loan, National Defense Loan 1972. National Development Bonds, 7-year National Savings Certificate, 4th issue. 6.5% Gold Bonds, 7% Gold Bonds. All this interest from point number B to point number F, all this interest is totally exempt from tax. And since the entire interest is exempt from tax, there is no point in deducting the TDS. There is no point in deducting the TDS. Any security of central government or state government, any security of central government, state government, which is notified. Notified means for that it is notified for the purpose of exemption. In that case, TDS should not be deducted. However, central government has issued 8% savings taxable bonds in the year 2003 and 7.75% saving taxable bonds in the year 2018. Central government had issued 8% saving taxable bond in the year 2003 and 7.75% saving taxable bond in the year 2018. Since the interest on these bonds is taxable, TDS is required to be deducted if the interest amount is exceeding 10,000. If the interest amount is exceeding 10,000, then TDS is required to be deducted. If interest is say 15,000, then TDS should be deducted on entire 15,000, or should it be deducted only on excess over and about 10,000? Answer is it should be deducted on entire 15,000. Whenever a limit is given in the question, limit is given in the section, if that particular limit exceeds, then you should deduct TDS on entire amount. You should deduct TDS on entire amount. Have you understood this point number B to point number G? Let's move on further. Notified bonds of Power Finance Corporation Limited. Notified bonds of Indian Railway Financial Corporation Limited. Do remember Chapter of capital gain we have discussed section 54 EC. You can sell land building. Whatever capital gain arises on sale of land building, you can invest money. Bonds of National Highway Authority of India, bonds of Rural Electrification Corporation, bonds of Power Finance Corporation Limited, bonds of Indian Railway Financial Corporation Limited. Interest on all these bonds is totally exempt from tax. Interest on these bonds is exempt from tax. Therefore, there is no point in deducting TDS. This interest will not be taxable. This will be exempt. If you recollect in the chapter of income from other sources, we had discussed the section 10 clause 15. In section 10 clause 15, list was given. If you want interest out of those avenues of investment, then interest is exempt from tax. And whenever interest is exempt from tax, you should not deduct any TDS. You should not deduct any TDS. So point number H is over. Now I move on to point number A. Point number A says it is not necessary to deduct tax on interest on debentures. Interest is received on what? Interest is received on debentures. This interest is paid to whom? This interest is paid to resident, individual or HUF. Number one, interest is paid on debentures, and number two, it is paid to resident, individual or HUF. If following three conditions are satisfied, then TDS should not be deducted. If following three conditions are satisfied, then TDS should not be deducted. The first condition is company should be a widely held company. Widely held company means public company. Number two, interest is paid by account paycheck. Interest is paid by account paycheck. And number three, the aggregate amount of interest does not exceed 5,000. Aggregate amount of interest does not exceed 5,000. In that case, TDS will not be deducted. So if the payee is resident, individual HUF, interest is paid on debentures, interest is paid by public company by account paycheck, and the amount of interest does not exceed 5,000, then TDS will not be deducted. See, we are not saying that this interest is not taxable. We are just saying that TDS will not be deducted. Say, for example, you are receiving an interest on debentures of 4,000. You have received a interest of 4,000 on debentures. Then the company will not deduct TDS. That does not mean that interest is not taxable to you. That interest you should add to your income, and you should calculate tax and pay tax to the government. So if tax is not deducted because it does not exceed a specified limit, that amount payee has to include in his income and pay the tax. Yes, have you understood this? Yes or no? Yes, okay. So point number A is over. Now we are left with 2 points, point number I and point number J. Point number I says small people should not deduct TDS of big giant corporations which are connected to the government. For example, Life Insurance Corporation of India, General Insurance Corporation of India, or subsidiary of General Insurance Corporation. Do you know that these are the government institutions? LIC of India is a government institution into life insurance business. GIC of India is having general insurance business. GIC is also having 4 subsidiaries: Oriental Insurance, National Insurance. All these 4 subsidiaries of GIC. So whenever anyone is paying interest to LIC, GIC or subsidiaries of GIC, then you should not deduct TDS, because government says we have more faith on them as compared to the payer. So while paying interest to them, don't deduct TDS. We will collect tax directly from them only. For example, LIC has invested money in the bonds of Muthoot Finance. LIC has invested money in bonds of Muthoot Finance. Then Muthoot Finance should not deduct TDS while paying interest to LIC. Muthoot Finance should not deduct TDS while paying interest to LIC. LIC, GIC, etc. They will pay tax directly to the government. We should not deduct TDS if we are paying interest to LIC. Is that very clear? Point number I. Yes. Yes, let's move on to the last point. This last point was introduced only in the year 2016. Any security issued by the company, who is issuing the security? Company is issuing the security. These securities are issued in dematerialized form. They are issued in electronic form, demat form, and those securities are listed on a stock exchange in India. In that case, tax is not required to be deducted. In that case, tax is not required to be deducted at all. So if you have invested money in the securities of any company and you have got the securities in dematerialized form and those securities are listed on a stock exchange, then tax will not be deducted irrespective of amount. Whatever may be the amount of interest, tax is not required to be deducted. So with this, you have completed section 194C. Next is section 194. See, now all these sections are smaller ones. The big sections are section 192, 194C, 194J. We have 3-4 big sections. Rest all are very small sections. Yes, I am giving you 1 minute's time. Kindly refer this point. Section 194. Refer this entirely. I can give you 1 minute's time. 194. Refer this quickly. Have you referred section 194? Okay. It's a very small and simple section. This section is once again activated because you know that from this year onwards, domestic companies, they are not going to pay any dividend distribution tax. Dividend is fully taxable in the hands of shareholders. Since dividend is fully taxable in the hands of shareholders, company will deduct TDS at the time of payment of dividend. So section is 194. Nature of payment is TDS on dividend income. Dividend paid by whom? Domestic company. So payer is a domestic company, payee is any resident person. What if payee is non-resident? Then you deduct TDS in section 195. Whenever the section is made for deducting TDS only in case of resident person, in such case, if you are making payment to non-resident, then you should deduct TDS in which section? Section 195. So if payee is resident, you deduct TDS in 194. Payee is non-resident, you deduct TDS in 195. When to deduct TDS? At the time of actual payment. At what rate? 10%. However, this 10% amount is reduced by 10% is reduced by 25%. So that is new rate of TDS will be 7.5%. This is applicable only because of COVID. Because of COVID-19, government had reduced the TDS rates in lot of sections by 25% flat. So the TDS rate will be 7.5% from 14 May 20 to 30th March 21. Minimum amount not liable to TDS is 0. Minimum amount not liable to TDS is 0. Here we are saying that no TDS if certain conditions are fulfilled. No TDS if certain conditions are fulfilled. How many conditions? 3 conditions. If pay is a individual shareholder, TDS is paid by any mode other than cash, and the dividend amount, pay is a individual shareholder, the dividend is paid by any mode other than cash, and the amount of dividend does not exceed 5,000. If these 3 conditions are fulfilled, then TDS will not be deducted. See, when we say minimum amount not liable to TDS means TDS should be deducted on any amount of dividend. whatever may be the amount of dividend, you should deduct the TDS. Whatever may be the amount of dividend, you should deduct TDS. But here we are saying that if pay is individual, dividend is paid by any mode other than cash, and the amount of dividend does not exceed 5,000. Amount of dividend does not exceed 5,000. In that case, TDS will not be deducted. And the last point is, if the dividend is paid to LIC, GIC, or 4 insurance companies which are subsidiary of GIC, in that case, TDS is not required to be deducted. So this point is similar to interest on securities point. So when you pay interest on securities to LIC, GIC, or 4 subsidiary companies of GIC, no TDS. Here also, when you pay dividend to LIC, GIC, or 4 insurance companies of GIC, you should not deduct any TDS. Government will collect tax directly from them only. You should not deduct TDS. Yes, is that very, very clear? Sarvana, TDS will be deducted because dividend is taxable in the hands of shareholder. Whether it is normal dividend or deemed dividend, it will not make any difference. When the dividend is paid by domestic company, TDS will be deducted in this section. If foreign company pays dividend, this section will not apply. All domestic companies, all Indian companies are by default domestic companies only. All Indian companies are by default domestic companies. Sarvana, shall I proceed to the next section? Okay. Section is 194A. Nature of payment is interest other than interest on securities. This interest other than interest on securities will include what? Interest other than interest on securities will include what? All interest other than interest on securities. So, interest on debentures, interest on bonds, and interest on government securities, keep aside these 3 things. Why? Because that is covered by section 193. That is covered by section 193. So, which interest will be included here? Interest on savings account, interest on FD account, interest on recurring deposit account. If I have taken loan from you, then whatever interest I am paying to you. Whatever interest you are paying to bank on the loan taken, all these interests will be covered by section 194A. Payer, listen to me. This explanation I am giving only once, but this is applicable in 5 sections. Section 194A, section 194C, 194H, 194I, and 194J. 5 sections are giving you the same condition. What should be the nature of payer? The payer we are dividing in 2 categories, individual HUF and others. Payer we are dividing in 2 categories, individual HUF and others. Others means other than individual HUF. If the payer is other than individual HUF, then they should always deduct TDS while paying interest other than interest on securities. If the payer is other than individual HUF and that payer is paying interest, then he should always deduct TDS. He should always deduct TDS. What if payer is individual HUF? If payer is individual HUF, if he is into business, then he should deduct TDS only if the turnover of his business is more than 1 crore. Or if he is into profession, then he should deduct TDS only if gross receipts from the profession are more than 50 lakhs. Gross receipts from profession are more than 50 lakhs. Is that very, very clear? So, I can now say only one sentence. I can convert these 2-3 sentences into one sentence. I can say that every person should deduct TDS except those individuals and HUF whose business turnover does not exceed 1 crore or gross asset does not exceed 50 lakhs. Everyone should deduct TDS except two. Those individual HUF whose business turnover does not exceed 1 crore and those individual HUF whose gross asset from profession does not exceed 50 lakhs. Have you understood this? So government has given the duty or right to deduct tax to everyone. But in case of individual HUF, government is seeing what is the financial position. For that, government says, what was the turnover of your business in the last year? Not in the current year. They are asking you the turnover of the last year. Say, for example, current year is 2021. Your previous year is 2021. So they will not see the turnover of previous year 2021. They will see the turnover of earlier year. That is 1920. If the turnover of 1920 is more than 1 crore or gross receipts of the year 1920 are more than 50 lakhs, then while making payment of interest in the current year, you should deduct TDS. So this turnover and gross receipts, they are not checked for the current year, they are checked for the last year. Last year means immediately preceding financial year. Immediately preceding financial year. Yes, have you understood this? Let us proceed now. Pay is any resident person. If pay is non-resident, you go and deduct TDS in section 195. If pay is resident, you deduct TDS in section 194A. When to deduct TDS? TDS should be deducted at the time of actual payment of interest or at the time of crediting pay's account, whichever is earlier. When to deduct TDS? At the time of actual payment of interest or at the time of crediting the pay's account, whichever is earlier. So you should deduct TDS at the earliest occasion. This motor accident claim tribunal, this point I will explain you after some time. What is the rate of TDS? 10%. But because of COVID, the rate is reduced to 7.5% if the interest is paid during 14th May 20 to 30th March 21. Minimum amount not liable to TDS. Now this point is very important. This point is very important. First of all, you look at the nature of payer, then you look at the nature of pay, and then you decide what is the minimum amount not subject to TDS. So there are different amounts which are not subject to TDS, different minimum amounts not subject to TDS. That will be decided. Take into account what? Nature of payer and nature of pay. If nature of payer is bank, cooperative bank, post office. If nature of payer is bank, cooperative bank, post office. In other words, you have kept FD with bank, cooperative bank, post office, or you are having a recurring account with bank, cooperative bank, post office. In that case, they will deduct TDS in case of resident senior citizen only when the amount of interest is more than 50,000 per branch per pay. Amount of interest is more than 50,000 per branch per pay. Sarvana, 80 DTB deduction is available up to 50,000. Yes. And here we are saying that TDS will be deducted only if the amount of interest per branch per pay is more than 50,000. In other words, for example, the rate of interest is at 10%. You are keeping a FD of 10 lakh you are keeping a FD of 10 lakh with particular bank. In that case, bank will pay you interest how much? In that case, bank will pay you how much interest? 1 lakh rupees. Bank will pay you 1 lakh rupees interest. Should they deduct TDS? Yes, they should deduct TDS. But instead of that, if you go and keep FD with two different banks or two different branches of the same bank, you are keeping an FD of 5 lakhs each. In that case, the 10% interest works out to only 50,000. So every branch is paying you interest of 50,000. Every branch is paying you interest of 50,000. In that case, they should not deduct TDS. Have you understood this? So minimum amount not liable to TDS will be 50,000. In case the payer is bank, cooperative bank, post office, payee is resident senior citizen, and the minimum amount not liable to TDS is 50,000. Dixit, this interest is anyway taxable, irrespective of the amount. Even if the interest amount is 10,000 now, that is taxable only. The only thing is we are not deducting TDS. Only thing is we are not deducting TDS, that's all. Are you understanding? Dixit, if we do not deduct TDS, that doesn't mean that your interest is not taxable. Sarvana, wait for some time. Your question will be answered in this point number A. Wait for some time. Please understand that if TDS is not deducted, that doesn't mean that your income is not taxable. If TDS is not deducted, then also your income is taxable. TDS is not deducted, then also your income is taxable. The only thing is we are not deducting TDS on smaller amounts. Otherwise, those small people will also get caught in this TDS provision. So government says if the payer is bank, cooperative bank, post office, payee is a resident senior citizen, then TDS will not be deducted if the interest is 50,000 per branch per payee. So I had given an example saying that you have kept a FD of 10 lakh with one branch. That branch is paying you interest of 1 lakh rupees. Will they deduct TDS? Definitely yes. What if you have kept a FD with two different branches of same bank or two different banks? You have kept a FD of 5 lakh each and you are receiving an interest of 50,000. You are receiving an interest of 50,000. In that case, what will happen? Will they deduct TDS? Answer is no, because the amount of interest does not exceed 50,000 per branch per pay. Now you will feel that yes, in that case, people can take the undue advantage. That point will be answered in point number A. That doubt will be answered in point number A. Next point is if the payer is bank, cooperative bank, post office. Next point is if the payer is bank, cooperative bank, post office. Payer is bank, cooperative bank, post office, and the pay is other SSE. Other SSE means other than resident senior citizen. Pay can be non-senior citizen. Pay can be non-senior citizen, or pay can be other than individual. Pay can be HUF, pay can be firm, etc. In that case, the amount applicable in that case, minimum amount not subject to TDS applicable is 40,000 rupees. Minimum amount not subject to TDS is how much? 40,000 rupees. Dikshit, same point is applicable everywhere. If the amount exceeds this limit now, then TDS should be deducted of entire amount. This you keep in mind for all the sections. For all the sections, everywhere there will be some amount given. If the actual payment exceeds that amount, then TDS will be deducted on the entire amount only. So in case the pay is resident senior citizen, limit is 50,000 per branch per pay. If the pay is other person, then 40,000 per branch per pay. Next is payer is other than bank, cooperative bank, post office. Say for example, I have taken loan from you. For example, I have taken a loan from you. I am paying interest to you. I am a payer, you are paying. Am I a bank? No. Am I a cooperative bank? No. Am I a post office? No. In that case, we say that payer is any other person other than bank, cooperative bank, post office. If the pay is resident, senior citizen, then the limit will be 50,000 here also. But if the pay is any other person, then the limit will be 5,000 rupees. Then the limit will be 5,000. Have you understood these limits? So different limits are applicable depending upon the nature of pay or nature of pay. Depending upon the nature of payer and nature of pay, different limits are applicable. If the pay is a resident senior citizen, the limit of 50,000 is applicable. In other cases, either 40,000 or 5,000, depending upon who is payer. Okay. Now let's move on to one more important point. Listen to me very carefully. Have you heard something called as a core banking solution in your EIS subject? Your EIS subject is over? CBS, yes, CBS. Where you have heard about CBS? In which subject? EIS. EIS, yes. See, core banking solution means there is a common database of all the branches. Mostly all banks are now following core banking solution. Say for example, State Bank of India. See what used to happen earlier. For example, you want to keep a FD of 1 crore and the rate of interest is 10%. If you go to particular branch of State Bank of India and keep a FD of 1 crore, then the interest would be how much? At the rate of 10%, it will be 10 lakh rupees. It will be 10 lakh rupees. Will they deduct TDS? Yes. Yes. So, to avoid this TDS provision, what you are doing now? Instead of keeping an FD of 1 crore with one branch, you are going to 20 different branches of State Bank of India. You are going to 20 different branches of State Bank of India and you have kept a FD of 5 lakh with each of the branch. Now every branch will pay you interest at 10%. So the amount of interest is 50,000 rupees. Now for example, you are a senior citizen. Pay is a senior citizen. In that case, 20 different branches of State Bank of India, they are paying interest to pay how much? 50,000. Will they deduct TDS? They were not deducting TDS because this 50,000 limit is applicable for per branch per pay. So people were taking the undue advantage. People were taking the undue advantage. Therefore, government came out with a provision saying that if the bank is having a core banking solution software, bank is having a common database. State Bank of India is having a common database. Common database means if I'm having an account with State Bank of India Mumbai branch, and if I withdraw money from Chennai branch of State Bank of India, then also my account will be updated saying that this much amount is withdrawn. Because they have adopted a core banking solution. Core banking solution means they are having a common database. In that case, government came out with an amendment in the year 2015 saying that if the bank has adopted core banking solution, then this limit should not be applied for each branch separately. This limit should be applied on a consolidated basis. This limit should be applied on a consolidated basis. So even if you keep a FD of 5 lakh with each of the branches and each branch is paying you interest of only 50,000, will they deduct TDS? Answer is yes, they will deduct TDS if they have adopted the CBS system. If they have adopted the CBS system. If they have adopted central banking or core banking solution, in that case, you have to apply the limit on a consolidated basis. So 20 different branches are paying you interest of 50,000. So your aggregate amount is 10 lakh rupees. Is that more than 50,000? Yes. So they should deduct TDS. So if they have adopted core banking solution, then this 50,000 should not be applied. Limit should not be applied per branch per payee. It should be applied per payee only. 50,000 per payee. Have you understood this? Yes. So now Deva is asking me question, sir, what if I deposit? What if I keep FD with different banks? Deva is asking me question, sir, what if I keep an FD with different banks? In that case, what will happen? In that case, they will not deduct TDS because you don't have a common database of all the banks. You don't have a common database of all the banks. So now if you see, if TDS is not deducted, that doesn't mean your tax liability is zero. If TDS is not deducted, then you are supposed to pay tax directly to the government. Now, if you want to ensure that TDS should not be deducted, in that case, you can go to 10 different banks. Instead of 10 different branches of the same bank, you go to 10 different banks and keep FD. Or maybe you go to 20 different banks and keep FD. Every bank is paying interest of only 50,000. No bank will deduct TDS. Because for all the banks, we don't have common database. Yes, have you understood this? Yes or no? Shall I proceed? Yes or no? Okay. Now listen to me very carefully. See, in this section 194A, TDS is required to be deducted at the time of payment or at the time of credit, whichever is earlier. But if you refer to the books of accounts of bank, if you refer to the books of account of bank, say for example, you have kept a FD with the bank, and bank is going to give you interest at the time of maturity. Even though bank is going to give you interest at the time of maturity, bank will calculate interest every month and they'll pass entry in their books every month. Why? Because bank is following mercantile system accounting. Since bank is following mercantile system accounting, they will calculate interest every month and they'll pass the entry for interest every month. They are just passing this entry to comply with the mercantile system accounting. While passing this entry, they will credit the payee's account. They'll pass an entry. For example, you have kept an FD with bank for a period of 2 years, and you have kept a FD on 1st April 2019. Then at the end of April 2019, bank will calculate interest for 1 month. They'll pass an entry interest account debit to depositors account, interest account debit to payee's account. But actually, they are not going to pay you interest. This entry, which is passed at the end of month number 1, will get reversed at the beginning of month number 2. And month number 2, once again, they will pass an entry for 2 months interest. At the beginning of month number 3, that 2 months interest entry will be reversed. And at the end of month number 3, entry will be passed for interest for 3 months. Why this thing is done? So that they comply with the mercantile system accounting. Just because they want to comply with the mercantile system accounting, they are passing the entry at the end of the month and they are reversing the entry at the beginning of next month. That doesn't mean that they have credited the payee's account. That doesn't mean that they have credited the payee's account. Payee's account will be deemed to be credited when actually interest is payable. So in our example, if interest is payable on maturity, because it is a CTD account, cumulative time deposit account, in that case, interest is payable on maturity. If interest is payable on maturity, then TDS should be deducted at the time of maturity only. Have you understood this? Yes or no? So here it says it is clarified that since no constructive credit is made to the depositor or payee account while calculating interest on time deposit on daily or monthly basis in the CBS software used by the banks, tax needs to be deducted at source on such provisioning of interest by the bank. Tax needs to be deducted only when the payee's account is actually credited or payment is actually made. At the end of the month, when you pass an entry for outstanding interest, at that point of time, tax should not be deducted. In such cases, tax shall be deducted at source on accrual of interest at the end of the financial year or at the periodic intervals as per the practice of the bank. So whenever actually payee's account is getting credited, at that point of time, tax should be deducted. Only for complying with the mercantile system accounting, if bank is passing an entry for outstanding interest at the end of each month, then at that point of time, tax is not required to be deducted. Next is point number C. See here, what is the minimum amount not liable to TDS? Minimum amount not liable to TDS is 50,000, 40,000, 50,000, 5,000. Different payer, different pay, different limits. But if the interest is paid on compensation awarded by motor accident claim tribunal, if interest is paid on the compensation awarded under motor accident claim tribunal, in that case, the amount which is not liable to TDS is 50,000 in all the cases. It is 50,000 in all the cases. What do you mean by this? Say, for example, I am having a four-wheeler. I am having a car. I have taken the insurance of the car. I am having a car and I have taken the insurance of the car. Now that car has met with an accident. Car has met with an accident and entire car is destroyed. In that case, definitely I would make the insurance claim from the insurance company. I will ask the insurance company to compensate me. And say, for example, insurance company said that car has not met with an accident, intentionally have done this to claim, to make the claim, since your car had become very old, intentionally you push the car and car met with an accident. So it is not an accident which has actually taken place. Intentionally car is destroyed and you are now making a claim. So there is a fight between me and the insurance company. Insurance company says that intentionally you have done this to make the claim, and I am saying that no, genuinely car is met with an accident. So now I am fighting a case against the insurance company in the court of law. Now say, for example, in the court of law, if I win the case, if I have won the case in the court of law, then insurance company would be required to compensate me now. They would be required to pass the claim. But I will ask them to give me the claim amount along with interest. Say, for example, accident happened in the financial year 2021 and the case was fought between the insurance company and me for 5 years. At the end of 5th year, insurance company has lost the case. So they are liable to pay me compensation. Definitely they are liable to pay me compensation, but I will also ask them to pay interest for 5 years now. So court will definitely grant interest also. That is called as interest on compensation awarded by motor accident claim tribunal. Whatever compensation motor accident claim tribunal, that is court, has awarded, on that compensation, interest will also be paid. For that interest, limit is 50,000. TDS will be deducted only if the interest amount is more than 50,000. TDS will be deducted only if the interest amount is more than 50,000. At the same time, I want to add one more point here. minimum amount not liable to TDS I have explained you. But at the same time, I want to add one more pointer saying that in this section, generally TDS is deducted at the time of payment or credit, whichever is earlier. In this section, generally TDS is deducted at the time of payment or at the time of crediting pays account, whichever is earlier. But in case of interest, on compensation awarded by motor accident claim tribunal, in case of interest on compensation awarded by motor accident claim tribunal, TDS is required to be deducted at the time of payment only. TDS is required to be deducted at the time of payment. See here, I had not explained to this point now. So this point I have covered right now. In case of interest on compensation awarded by motor accident claim tribunal, tax should be deducted at the time of actual payment of interest. Have you understood this? Yes or no? Okay. So now let's move to the last few points. Point number 7. No TDS under section 194A in the following cases. No TDS in 194A in following cases. What is that? Where the interest is paid or credited by the partnership firm to resident partners. If partnership firm is paying interest on capital, interest on current account balance to the resident person, then they should not deduct TDS. What if they are paying interest to non-resident partners? Then yes, they should deduct TDS in section 195, not here, but in section 195. So when the interest is paid by the partnership fund to the resident partner, they will not deduct any TDS irrespective of amount of interest. But if the interest is paid to non-resident partners, then they will deduct TDS in section 195. Second point says interest paid or credited by a cooperative society. When the payer of the interest is a cooperative society, these points are applicable. Interest is paid or credited by a cooperative society to its own members. The word cooperative society does not include cooperative bank. The word cooperative society will not include cooperative bank in this case. So if the cooperative society is paying interest to its own members, they should not deduct TDS irrespective of amount of interest. Irrespective of amount of interest, they should not deduct any TDS. If interest is paid by one cooperative society to any other cooperative society, then also TDS is not applicable. Interest is paid by one cooperative society to any other cooperative society, TDS will not be applicable. Interest is paid in respect of deposit made with primary agriculture credit society, primary credit society, or cooperative land mortgage bank or cooperative land development bank. If you have deposited money with these institutions, primary agriculture credit society, primary credit society, cooperative land mortgage bank, or cooperative land development bank. If you have kept the deposits with them, they are paying you interest. In that case, they should not deduct TDS. So if you invest money in FD with these institutions, while they pay you interest, they will not deduct TDS. Last point, interest paid or credited on deposits other than time deposit with a cooperative bank engaged in banking business. See, cooperative bank engaged in banking business is called as cooperative bank. Cooperative bank which is engaged in banking business will be called as a cooperative bank. So this point says that interest is paid in respect of deposits other than time deposits with a cooperative bank engaged in banking business. Then they would not deduct TDS. Then they would not deduct TDS. Have you understood these points? Yes. Yes or no? Here, this paragraph is a budget 2020 amendment. This paragraph is a budget 2020 amendment. What it says, with effect from 1st April 20, that is assessment at 21-22, cooperative society shall be liable to deduct tax at source in following cases. I have discussed 4 cases with you. Above 4 points are discussed. Interest is paid by cooperative society to its own members. Interest is paid by cooperative society to any other cooperative society. Interest is paid in respect of deposit with primary agriculture society, primary agriculture credit society, cooperative land development bank, cooperative land mortgage bank. Or interest is paid on other than time deposit and it is paid by cooperative society engaged in banking business. In that case, TDS is not required to be deducted. That is what we understood. But with effect from 1st April 20, that is budget 2020 amendment, these cooperative societies will be liable to deduct tax in all the above mentioned cases if following 2 conditions are fulfilled. If following 2 conditions are fulfilled, then the cooperative societies will be liable to deduct tax. What is the first condition? The total sales, gross receipt or turnover of a cooperative society is more than 50 crores during the last year. What is the current year? Current year is 2021. Current year is 2021. So in last year, that is 1920, if the total sales, turnover or gross receipt of the cooperative society was more than 50 crores, then in the current year, this cooperative society should deduct the TDS. So up to last year, a blanket exemption was given for not deducting TDS. Up to last year, for these 4 points, blanket exemption was given. Means they were cooperative societies were not liable to deduct the TDS. From current year, what has happened? They have now inserted the condition. If the cooperative society's total sales, gross receipt or turnover is more than 50 crores, it was more than 50 crores in the immediately preceding financial year, then they should deduct TDS in the current year. Then they should deduct TDS. They should deduct TDS only if the amount paid is likely to exceed 50,000 in case of a senior citizen and 40,000 in case of a non-senior citizen. That limits are applicable. That limits are applicable. So up to last year, cooperative societies were not deducting TDS. Now onwards, cooperative societies are asked to deduct TDS, but only if their turnover, sales, gross receipt of the immediately preceding financial year was more than 50 crores. Was more than 50 crores. Yes, have you understood this? Okay, let us proceed further. Point number 3, I have already explained you. Interest on compensation awarded by Motor Accident Claim Tribunal. TDS will be deducted at the time of actual payment only if the amount of interest exceeds 50,000. What if the interest does not exceed 50,000? Then no TDS. Then no TDS. No TDS on zero coupon bonds. Since zero coupon bonds, you are not going to receive any interest. So therefore, there is no question of deducting TDS. Interest on savings account. If you are having a savings account, on that in that savings account, whatever balance you are having, on that if you have received any interest, then bank is not going to deduct TDS. So interest on FD is liable for TDS. Interest on recurring deposit is liable for TDS, but interest on saving bank account is not liable for TDS. See, I am not saying it is not liable to tax. I am saying it is not liable for tax deduction. If at all that interest is within the taxable limit, then definitely payee has to pay tax directly to the government. So whenever bank is paying interest to you on savings account, they would not deduct TDS. Whenever bank is paying you interest on savings account, they will not deduct TDS. You have to pay tax directly to the government. If your extra tax is deducted in the form of TDS, etc., then you are going to receive the refund. Excess income tax paid will be refunded to you. On that refund, you are eligible to claim interest. On that refund, you will get the interest. So that interest on income tax refund. Interest on income tax refund. Government is giving you interest on income tax refund. Government is not going to deduct TDS. If at all that interest is taxable, you pay tax directly to the government. TDS will not be deducted. Last point. You have deposited money in any scheme framed by the central government. If you have deposited money in any notified scheme framed by the central government, then your interest income will be exempt from tax. Therefore, there is no question of deducting TDS. What are the notified scheme framed by the government? Post office time deposit, post office monthly income account, national savings certificates, Kisan Vikas Patra, Indira Vikas Patra. All these are the schemes which are notified by the government. If you receive interest on this, then TDS will not be deducted. Then TDS will not be deducted. This point number 8 is not relevant at IPCC level, so I am skipping this point. No TDS under section 194A if payee is bank or cooperative bank, UTI, LIC, any other insurance company or a corporation established under Central State Provincial Act. Listen to me very carefully. While bank is paying you interest, they will deduct TDS. While bank is paying you interest, they will deduct TDS. But while you are paying interest to bank, you should not deduct TDS. While bank is paying you interest, bank is a payer, they will deduct TDS. But when you are paying interest to bank, you should not deduct TDS. Otherwise, all those people, lakhs and crores of people might have taken loans from the bank now. So those people might be paying interest to bank. On that, they should not deduct TDS. See, government will have more faith on bank as compared to you. As compared to individuals, government will have more faith on banks. Therefore, government says, when you pay interest to bank, do not deduct TDS. Bank can deduct TDS while making payment of interest to you. But when you are making payment of interest to the bank, you should not deduct TDS. Is that very clear? Yes or no? Shall I proceed? Point number C says interest payable and receivable should not be set off. Interest payable and receivable should not be set off. In other words, for example, I have to pay interest of 1 lakh to you. I have to pay interest of 1 lakh to you, and you have to pay me interest of 60,000. In that case, we should not set off this 60,000 and deduct TDS on only 40,000. I will deduct TDS on 1 lakh and you should deduct TDS on 60. So interest payable and interest receivable will not be set off against each other. Interest payable and interest receivable will not be set off against each other. Have you understood this? So we both should deduct TDS while we are making payment of interest to each other. Interest payable and interest receivable should not be set off. No TDS if the interest is paid to National Skill Development Fund. See, this National Skill Development Fund is a fund which is set up by the central government. If you are paying interest to that fund, you should not deduct TDS. Point number E. Sometimes when you are fighting a case in the court of law for the for securing the interest of revenue, court may ask you to pay money beforehand. For example, you are fighting a case against the GST department, saying that my GST liability is only 1 lakh, whereas GST department is saying that your liability is 5 lakh rupees. So in that case, court says that we will allow this case to proceed further. First, you do one thing: you deposit 5 lakh with us. You deposit 5 lakh with us. So what you have to do now? You have to keep a FD in the name of Registrar General of Court. Registrar General of Court is the officer of the court. In his name, you have to create an FD, and that FD receipt you have to submit to the court. Thereafter, only case will be proceeded further. Now, till the time the case is going on, it is not certain whether that money belongs to you or whether the money belongs to the government. Therefore, this point number E says that TDS should not be deducted. Point number E says that TDS should not be deducted when the interest on FD is made in the name of Registrar General of Court. But yes, TDS should be deducted only when the case is concluded. When the case is concluded and it is decided that this money now belongs to the SSE. In that case, bank will pay interest to the SSE and bank should deduct TDS. Dikshit, we can have a break after completing this section at least. Half page is only left. We can complete this section and then we can have a break. See, this chapter is full of theory. This chapter you should refer from the summary notes. This 16 pages now you have to read 3-4 times. If you read only once now, you will not remember anything. And in this chapter now, teacher has no role to play. Teacher has no role to play. Even if I don't teach this chapter and give it to you for self-study, now you will understand the same things. So around 60%, 70%, it is just that you have to read and understand. Remaining 25-30% teacher has to explain. So teacher has a very limited role in teaching this chapter. But have you understood point number E? Yes. So if you have kept an FD in the name of Registrar General of Court, then bank will not deduct TDS till the time the case is going on. TDS will be deducted only on the conclusion of the case. On the conclusion of the case, it is decided in favor of the SSE. In that case, whatever FD was kept in the name of Registrar General of Court will be transferred to the SSE. At that point of time, interest will be given, and on that interest, TDS should be deducted. So TDS will be deducted, but when? At the time of conclusion of the case. Point number F says, deduction of tax at source on income accrued to the minor child where both parents have deceased. In the chapter of clubbing, see, clubbing chapter, I have already, yesterday I told you that clubbing chapter I have recorded for you and that will be uploaded in the app. In that clubbing chapter, we have one section, section 64, subsection 1A, which says that minor's income will be clubbed in the income of parent. So whatever income minor is earning now, that income will be added to the income of parent and tax will be levied. So if that income is taxable in the hands of parent, then TDS should be deducted in the hands of parent only. And parent only should get the TDS credit. But what if the parents have died? Father, mother, both have died. In that case, income will be taxable in the hands of minor child only. and TDS is required to be deducted against the PAN number of minor child. Generally, income of minor child is taxable in the hands of either father of minor child or mother of minor child. If they are alive, then income will be taxable in the hands of parent. TDS should be deducted in the hands of parent using the PAN number of parent. But if father, mother both have died, in that case, if interest is received by minor child, then TDS will be deducted against the PAN number of a minor child. Yes, is that very, very clear? Point number F. Let's move on to the last point. If you remember in the chapter of capital gain, we have discussed amount deposited in the capital gain account scheme. If you want to claim exemption, either you have to purchase the asset or you have to deposit money in the capital gain account scheme up to the due date of filing date. At that point of time, someone had asked me the question saying that, sir, whatever amount we deposited in the capital gain account scheme, are we going to get interest on that? If yes, what is the treatment? So answer is yes, you will get interest. Some negligible interest, which rate of interest will be similar to saving bank account interest. Will that interest be taxable? Yes, that interest will be taxable. So whether the TDS is required to be deducted? Yes, TDS is required to be deducted. What if the person who has opened the capital gain account scheme has died? What if the person who has opened the capital gain account scheme, the person who has opened a capital gain deferred account has died? In that case, up to the date of death, TDS will be deducted against the PAN number of depositor only. Up to the date of death, TDS will be deposited. TDS will be deducted and deposited with the government against the PAN number of depositor. After the date of death of depositor, TDS will be deducted and deposited with the government against the PAN number of legal heirs. But in any case, this interest is taxable. Interest earned on capital gain deferred account balance is taxable if the person who has deposited the money is alive. Then TDS will be deducted and paid to the central government using the PAN number of the depositor. If the depositor has died, then that money belongs to his legal heirs. In that case, while paying interest on that balance, TDS should be deducted and deposited against the PAN number of legal heir. Have you understood? Last point says, this last point is inserted recently with effect from assessment at 21-22. This point is just giving powers to the central government to issue the notification saying that following interest is exempt from tax, so TDS should not be deducted. So this point is giving authority to the central government to issue the notification and say that since this interest is exempt from tax, TDS should not be deducted on this interest. So with this, our section 194A is over. This section 194A is summarized here in one page. 194A is summarized here in one page. So we have completed section 194A. Now we'll move on to two small sections, 194B and 194BB. 194B and 194BB, two very small sections. 194B talks about winning from lottery, crossword puzzle, card game, etc. Winning from lottery, crossword puzzle, card game, or any other game of any sort. You know that this income is taxable in section 115BB at the rate of 30%. winning from gambling betting are not covered here. But winning from gambling betting is also taxable at 30% only. Payer is any person. So payer can be individual, HUF, firm, company, association, a person, body of individual. It can be anything. It can be anyone. Payer is the person who has organized this lottery, or a lottery vendor. Payer can be a lottery vendor. Pay is the person who has won the lottery or the crossword puzzle. Pay can be any person, whether resident or non-resident. TDS should be deducted at the time of actual payment of winnings. Rate of TDS is 30%. Amount not liable to TDS is 10,000. So if the amount of lottery winning is 10,000, up to 10,000 rupees, TDS will not be deducted. That doesn't mean that amount is not taxable. That amount is still taxable, but TDS will not be deducted. That's all. What if winnings are partly in cash and partly in kind? Or winnings are wholly in kind? Say, for example, you have participated in some TV show and you have won a Volkswagen Vento car costing 10 lakh rupees. In that case, winning is in kind. In that case, how TDS will be deducted? On that winning of 10 lakh rupees, tax turns out to be 30% TDS. So that turns out to be 3 lakh rupees. In that case, you will have to pay 3 lakh to the government and show the challan to the organizer. Only then the organizer would hand over the winning to you. Or you should pay 3 lakh to the organizer. Organizer will pay TDS to the government, and then the winning will be handed over to you. So if you want something in kind, if the winning is in kind, then the winner has to pay the TDS amount to the government, or winner has to pay the TDS amount to the organizer. Organizer in turn will pay the TDS amount to the government. Thereafter only winnings will be handed over to the winner. Rate of TDS in section 194B is 30%, and rate of tax is also 30% in section 194. Sorry, section 115 double B. So in this case, rate of tax and rate of TDS are same. What is lottery and what is card game, that is defined here. You can just refer, not important for examination. Now I am just explaining this point to you. From examination perspective, this will not be asked at CA intermediate level. Point D and E you have to refer. No one is going to ask you point D and E. That is just that if a question comes to your mind, what do you mean by lottery? Then lottery is also defined, card game is also defined. Income of a lottery agent from lottery tickets remaining unsold. Section 194B TDS will be applicable. See, the lottery organizer will give the tickets to the lottery vendor, and then lottery vendor will sell the tickets. Say, for example, 10,000 tickets were given by the organizer to the vendor. Out of 10,000, he has sold 9,900 tickets. 100 tickets are remaining unsold. Those 100 tickets now, organizer is not going to take back. Those 100 tickets will be thrown out now. So instead of throwing, the lottery agent would scratch the ticket himself. In that case, if he has won something, on that also 30% TDS will be applicable as per section 194B. So irrespective of whether the winnings are won by the purchaser who has purchased the lottery tickets, or winnings are received by the vendor on unsold lottery tickets, in both cases section 194B will apply. TDS will be applicable. Next is section 194BB, winning from horse race. In case of horse race, if you have betted money on a horse and that horse has won the race, then you are going to receive winnings. You will receive winning money from the bookmaker. Bookmaker means the person who is having a license to conduct the horse race, arrange the wagering and betting contracts. So, in a betting contract, if you won money in a horse race, then the wager would pay you money. On that, he should deduct 30% TDS. Pay can be any person, TDS should be deducted at the time of payment. At the rate of 30%, minimum amount not liable to TDS is 10,000. See, if you observe, then section 194B and section 194BB, na, due to COVID-19, the rate is not reduced. In other sections, the rate was reduced by 25%, but here in this section, rate is remaining the same. Rate of TDS is not reduced. Is that very clear? Yes. Rate of TDS is 30%. Rate of tax is also 30%. TDS is required to be deducted only if the amount of winnings is more than 10,000. What if the amount of winning is 15,000? TDS will be deducted on what amount? Will it be deducted on excess 5,000? Or will it be deducted on entire 15,000? Answer is entire 15,000. TDS will be deducted on entire 15,000. So we have completed section 194B as well as section 194BB. 194C is a very big section. I will not cover up today because today we have already covered one big section, that was section 192, TDS on salary. So let us not get into this section. 194C we will start tomorrow. Today I am skipping this section. Today I'll be doing small sections only. So next section we move on to is section 194D. 194D is TDS on insurance commission. Who will pay insurance commission to whom? Yes. Who will pay insurance commission to whom? Insurance company will pay insurance commission to the agent. Insurance company will pay insurance commission to insurance agent. So nature of payment is insurance commission. Payer is insurance company. Pay is a resident insurance agent. TDS needs to be deducted at the time of payment or at the time of credit, whichever is earlier. TDS needs to be deducted at the time of payment or credit, whichever is earlier. At what rate TDS is required to be deducted? 5%. Lower rate because of COVID is 3.75%. 5% is reduced by 25%. That is, new rate is 3.75%. That is applicable only from 14 May 22, 31 March 21. Minimum amount not liable to TDS is 1,515,000. Minimum amount not liable to TDS is 1,515,000. Insurance commission, what is defined here? So you can refer to this. All the insurance commission which is paid by the insurance company to its agent, whether it is commission for new policies or commission for existing policy, on every commission they have to pay. On every commission they have to deduct TDS. Next is section 194DA. 194DA talks about TDS on maturity policy of life, maturity proceeds of life insurance policy. If you recollect in the chapter of deductions from gross total income, while discussing section 80C, I had discussed the first point, and that was with respect to life insurance premium. There I had explained to that life insurance premium is allowed as deduction under section 80C, and that deduction is restricted to 10% of salary, 20% of salary, 15% of salary, etc. If the actual premium exceeds that particular limit, if the actual premium for the life insurance policy exceeds that particular limit, then maturity proceeds of LIC policy will be fully taxable. Then maturity proceeds of LIC policy will be fully taxable. And if maturity proceeds are fully taxable, then TDS is required to be deducted in section 194D. then TDS is required to be deducted in section 194D. So what is the nature of payment? Maturity proceeds of life insurance policy including bonus. Who will be the payer in that case? Insurance company. Who will be the pay? Any resident person who has taken the insurance. When to deduct TDS at the time of actual payment? What is the rate of TDS? Rate of TDS is 5%. Rate of TDS is 5%. Sarvana, sum assured does not include bonus. Correct. Sum assured does not include bonus. Here the rate of TDS is 5%. 5% of what? Income comprised in a maturity policy. 5% of once again I will open the deduction chapter. See, this deduction chapter I had taken the example to make you understand the deduction with respect to life insurance policy. If you remember, you have taken a policy of 5 years. Sum assured was 1 lakh and the premium was 20, 25, 20, 15, 10, 5 for year number 1, 2, 3, 4, 5 respectively. In that case, how much amount you are going to receive at the time of maturity? At the time of maturity, you will be receiving 1 lakh. How much premium you have paid during these 5 years? Yes. How much premium you have paid during these 5 years? Is 25 plus 20 plus 15 plus 10 plus 5. How much it is? 75. And how much maturity proceeds you will be receiving? 1 lakh. So TDS should be deducted on what amount? TDS should not be deducted on 1 lakh. TDS should be deducted on 1 lakh minus 75, that is 25,000. TDS will be deducted only on the income component. TDS will be deducted only on income component. So with effect from 1st of September 2019, 5% of income comprising the maturity proceeds. That is after deducting insurance premium paid by the resident SSC from the total sum received. Only balance will be liable to TDS. And what rate? 5%. But this rate of 5% is reduced to 3.75% because of COVID. Because of COVID, this rate is reduced from 5% to 3.75%. But this 3.75% will be applicable only during this period, 14th May 20 to 30th March 21. Minimum amount not liable to TDS is maturity proceeds less than 1 lakh. So TDS provisions will be attracted only when the maturity proceeds are either 1 lakh or more. Only when the maturity proceeds are either 1 lakh or more. This I have already explained you. When the maturity proceeds are taxable, only in that case TDS is required to be deducted. And you know that maturity proceeds of keyman insurance policy are always taxable. Maturity proceeds of keyman insurance policy are always taxable. So section 194 DA is over. Next is section 194E. You want to do practical sum? See, this I have summarized here. This table I have summarized here. This table is having only minimum amount not liable to TDS and the rate of TDS. Day before exam, you can refer from here. We'll solve 1-2 sums. Come on. Let's move on to page number 351. Page number 351. Question number 2. You try this question on your own. I'll give you 2 minutes time. Question number 2, try this on your own. And then we'll discuss. Okay. Let us go through this. Question 2 says, examine the obligation of person responsible for paying income to deduct tax at source and indicate the due date for payment of such tax wherever applicable. You forget about the second part of the question, indicate the due date for payment. You just think about the TDS. Point number 1, X Limited is an employer. X Limited is an employer, has credited the salary due for the financial year amounting to 7,20,000 to the account of X. X Limited is an employer, credited the salary due to the financial year amounting to salary due for the financial year amounting to 7,20,000 to the account of X, an employee in its books of account on 31st March. Q has not furnished any information about his income or loss under any other head or proof of investment or payment qualifying for deduction under section 86. Now definitely this is called the section 192. But my question is whether TDS will be deducted or it will not be deducted. Yes. Do you believe that TDS will be deducted? Answer is no, TDS will not be deducted. TDS will not be deducted. Why? Because in section 192, TDS is deducted only at the time of actual payment of salary. TDS will be deducted only when you actually pay the salary. Have they actually paid the salary? They have just credited the employee's account. In section 192, TDS is required to be deducted only at the time of actual payment of salary. Yes or no? Do you remember? There are a lot of small points. You'll have to refer this. When to deduct TDS at the time of actual payment. Here they have not made the payment. Actually, they have just credited the salary to employee's account. Therefore, TDS will not be deducted. TDS will not be deducted. So point number 1, answer is salary is just credited to the account of employee. It is not actually paid. Therefore, TDS is not liable to be deducted. Now refer to question number 2. Point 2. Why is an individual whose total sales in the business during the last year was 1.2 crores has paid 9 lakh by check to a contractor? See, with this now you will not be in a position to answer because it is covered in section 194C and I have not taught you 194C. Let us refer to question number 3, point number 2. Question 3.2. A TV channel pays 11 lakhs on 1st July 20 as a prize money to the winner of this program who will be a millionaire. So in the television, there is a program going on who will be a millionaire. That person has participated and he has won 11 lakh rupees. So on that, TDS will be deducted in this section. TDS will be deducted in section 194B. TDS will be deducted in section 194B at the time of actual payment of winnings at the rate of 30%, 30. So that will be 3,30,000. Yes. Let's refer to question number 3, point number 3. A turf club awards a jackpot of 5 lakhs. Turf club awards a jackpot of 5 lakhs to the winner of one of its races. Turf Club has awarded a jackpot of 5 lakh to the winner of one of its races. Means Turf Club means place where the horse race would happen. That is called as Turf Club. This will be covered by section 194BB. TDS will be deducted at 30%. On this 5 lakh, 1,50,000 TDS will be deducted at the time of payment. Is that very clear? Only horse race, yes. Only horse race. 194BB covers only horse race. No mention means Turf Club, na? Turf Club means you have to take horse race only. See, in India, generally horse race is only legal. In India, only horse race is legal. Other races are illegal. So, by default, you have to take it as horse race only. We'll refer to one more point. Question number 8, point number 3. Question number 8, point number 3. State government pays 20,000 rupees. State government pays 20,000 rupees as commission to one of its agent on sale of lottery tickets. So agent has sold the lottery tickets. You might be knowing that a lot of state governments also run the lottery. Lot of state governments, they also organize the lottery. So state government has paid commission to its agent on sale of lottery tickets. Sarvana, this is not winning from lottery. This is commission paid by the state government to the agent. Will this attract section 194B? Answer is no, it will not attract 194B. I wanted to just make you understand that this point will not attract section 194B because it is not winning from lottery. Definitely it will attract some other section. It will attract some other section. So Dikshit, we can do only this many sums. All other questions are related to some other sections. So we have completed 194DA. Now let's move on to section 194E. Section 194E talks about payment to a non-resident sportsman or non-resident sports association. See, in IPL, there are a lot of foreign players who are coming to India for playing cricket. So BCCI is paying money, paying match fees to them. BCCI is paying match fees to them, or the sponsors are paying. Team owners are paying. Team owners. Team owners are paying match fees to the foreign players. In that case, we say that payment is made to a non-resident sportsman. Or say, for example, Australian Cricket Board and Board for Control of Cricket in India, BCCI. They have organized India-Australia matches in India. So if the Australian players come to India to play the matches now, then BCCI has to pay money to Australian players also, as well as the Australian Cricket Board. Australian Cricket Board is a sports association. Australian Cricket Board is a sports association. whatever money you pay to the sports association is a guarantee sum. See, whether the Australian team is winning the match or whether they are losing the match, it will not make any difference. BCCI has to pay certain fixed sum of money to Australian Cricket Board. That is called as guarantee sum paid to the sports association. That is called as what? Guaranteed sum paid to the sports association. On that also tax is liable to be deducted. So section is section 194E. What is the nature of payment? Nature of payment is number one, payments made to non-resident sportsman or athlete. For what? For participating in any game or sports in India, or for doing advertisements. See, Royal Challengers Bangalore, na? Royal Challengers Bangalore team owner Vijay Mallya was owning the team, na? Royal Challengers Bangalore. Royal Challengers Bangalore team had lot of West Indies player. Royal Challengers Bangalore team had lot of West Indies player, na? Those West Indies players were coming in the advertisement of Kingfisher. Have you observed? In the television advertisement of Kingfisher, West Indies players were part of the advertisement. Bravo. And which is that player of West Indies, very popular player? Chris Gayle. Chris Gayle was there in the Kingfisher beer advertisement. Kingfisher beer advertisement, Chris Gayle was there. I do not know whether you have seen that advertisement or not. Those players are just shouting hula la 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 hula la. For that shouting also they have received money. That is called as income by way of advertisement. Some players would write articles in the newspaper. For example, in Times of India newspaper, you have a separate page called as Times Sports. In that Times Sports, now some player may write the article. For that also they would receive money from the newspaper company. That will also be liable for tax deduction at source. So a non-resident sportsman receiving money for participating in any game or sports in India, for advertisement, for remuneration for writing articles on any game or sports in India, whatever money you receive, that is liable for tax deduction at source. Besides, any money paid to non-resident sports association, that also is liable for tax deduction at source under section 194E. Besides that, there are a lot of non-resident entertainers visiting India. There are a lot of non-resident entertainers visiting India. 2-3 years back, that Canadian entertainer came to India. What is his name? A small kid, na? Very popular he was. In Mumbai, he came to Mumbai for a music show, and the tickets were being sold at 35,000, 40,000. So those entertainers coming to India, they would be paid money for their program. On that also tax is liable to be deducted in section 194E. Payer is any person, in individual HUF, firm, company, whatever it may be. Every payer is liable to deduct TDS. Pay non-resident sportsman. Pay is either a non-resident sportsman or non-resident athlete who is not a citizen of India, or payee can be a non-resident entertainer who is not a citizen of India, or payee can be a non-resident sports association. So payee can be either a non-resident sportsman or athlete, payee can be a non-resident entertainer, or payee can be a non-resident sports association. So I give an example of Australian cricket board. When to deduct TDS? TDS needs to be deducted at the time of crediting payee's account or at the time of actual payment, whichever is earlier. At what rate? Since we are making payment to a non-resident person, we should deduct TDS. Rate of TDS here is 20%. Plus, we should also deduct surcharge if applicable, and we should always deduct health and education cess at 4%. At the beginning of the chapter only, I told you whenever you are making payment to a non-resident person, you are liable to deduct surcharge and cess. Is that very, very clear? Yes. So when you are making payment to a non-resident sportsman, athlete, or entertainer, you should deduct TDS provided that non-resident person is not a citizen of India, or you are making payment to non-resident association, sports association. Payment for participating in game or sports in India, payment for writing articles in the newspaper, payment for advertisement, or guarantee sum paid to the sports association. Tax is required to be deducted in section 194E. Next is section 194EE. Section 194EE, payment under National Savings Scheme. Payment under National Savings Scheme. Can you see the word file? Yes? Okay. See, there are two things. You may feel that this National Savings Scheme you might have studied somewhere. You may feel that yes, I have studied that in section 80C. But you are not right. Because in section 80C, we did not study National Savings Scheme. In section 80C, we studied National Savings Certificate. National Savings Scheme and National Savings Certificate both are different. National Savings Scheme and National Savings Certificate are different. National Savings Scheme, this scheme came into existence only in 1987, and that scheme got expired in 1992. So this National Savings Scheme was in existence only for this period of 1987 to 92 for a period of 5 years. National Savings Certificate is existing as of now also. What is the difference between them? National Savings Scheme is forming part of EET schemes. It was falling into EET schemes. EET schemes means exempt taxable scheme. Exempt taxable scheme. What do you mean by exempt taxable scheme? When you invest money in National Savings Scheme, we will give you tax benefit in the form of deduction. We will give you tax benefit in the form of deduction. Deduction under section 80C, etc. That deduction was allowed during the period 1987 to 1992. That's all. So when you invest money, you claim deduction. Whatever interest you earn, that interest will be exempt from tax. But maturity proceeds are taxable. Maturity proceeds are taxable. Therefore, I said that it is forming part of EET scheme. So NSS is forming part of exempt taxable scheme. Means when you invest money, you will get tax reduction. Interest income earned will be exempt from tax, but maturity proceeds are taxable. Whereas National Savings Certificate, NSC, is forming part of EEE schemes. Means when you invest money, you will get deduction. Interest earned will be exempt from tax. Maturity proceeds will also be exempt from tax. Maturity proceeds will also be exempt from tax. Have you understood this? Since maturity proceeds are exempt, there is no question of deducting TDS because maturity proceeds are exempt. So question of deducting TDS does not arise in case of NSC. Question of deducting TDS arises only in case of NSS maturity proceeds. Therefore, we have a section for maturity proceeds of NSS, and that is section 194 EE. Payments in respect of deposits under NSS. Nature of payment, maturity proceeds under National Savings Scheme. Payer is any person, but here payer is the post office only, because this National Savings Scheme was run by post office only. Pay is any person. When to deduct TDS at the time of actual payment? TDS should be deducted at the time of actual payment. Rate of TDS is 10%. COVID concessional rate is 7.5%. Minimum amount not liable to TDS is less than 2,500. So TDS is required to be deducted only if the maturity proceeds are either 2,500 or more than 2,500. Very important point, no TDS if the amount is paid to legal representative. Person in whose name National Savings Scheme was purchased. If that person has died, after his death, money will be received by the legal representative, and that will not be taxable in the hands of legal representative. Therefore, TDS is not required to be deducted. Deva madam, NSS was from 1987 to 92, that is correct. But say for example, someone has invested money in NSS during 1990. Till now he has not withdrawn money. Then what? We are talking about deducting TDS at the time of maturity. It may happen that you might have invested in NSC in the year 1990 and your maturity proceeds are received in 2021. That can happen now. Yes or no? So we are talking about maturity only. So this was section 194 EE. Next is section 194F. 194F. TDS on payment for repurchase of certain units of mutual fund or UTI. See, in case of company, we call it as buyback of shares. In case of company, when the company is buying its own shares from its own shareholders, that is called as buyback of shares. But if the mutual fund is buying back its own units from the unit holder, then it is called as repurchase of units. Instead of using the word buyback, we call it as repurchase of units. So when a mutual fund is repurchasing units from the unit holder, they are paying the repurchase price, buyback price to the unit holder, and that is taxable in the hands of unit holder. Therefore, tax is required to be deducted. So the nature of payment here in section 194F is amount paid on account of repurchase of units covered in section 80 CCB subsection 2. 80 CCB section is not existing right now. It was existing during 93-94. So up to 93-94, you have invested money in the units of mutual fund, and mutual fund is buying back those units right now in the year 2021. Then whatever money mutual fund pay to you, that is definitely taxable. So TDS is required to be deducted. Your payer will be either mutual fund or UTI. Payee can be any person. When we write any person, we mean to say resident as well as non-resident, both. When to deduct TDS at the time of actual payment. At what rate? 20%, but COVID special rate is 15%. Minimum amount not liable to TDS is 0. So whatever amount you receive from that mutual fund for repurchase of units, that entire amount is taxable. An entire amount TDS is required to be deducted. Deduction under section 80CCB was allowable up to assessment in 93-94 on account of purchase of such units of mutual fund, subject to maximum of 10,000 per annum. So long back during 93-94, we had section 80CCB. At that point of time, if you invest money in units of mutual fund or UTI, then government was giving you deduction under section 80CCB to the extent of 10,000 per annum. At that point of time, you had invested money and that amount is received right now. That mutual fund is buying back its own units and is paying you money. In that case, that amount will become taxable and TDS is required to be deducted. Normally 20%, but COVID special rate during the period 14th May 20 to 31 March 21 is 15%. Next section is section 194G. 194G is TDS on lottery commission. TDS on sale of lottery commission. I just showed you in that question. Question number 5, I think. 1 point state government paying commission to lottery vendor. On that TDS will be deducted in question in section 194G. Yes, it was not 5, it was question number 8. Yes, it was question number 8. So in that question number 8, commission was paid by the state government to the lottery vendor. On that, tax is required to be deducted at source in section 194G. So nature of payment is commission, remuneration or prize money for stocking, distributing and purchasing and selling lottery tickets. Payer is any person, lottery organizer. Any person means payer can be individual, firm, HUF, company, etc. It will not make any difference. They have to deduct TDS. Payee is any resident person. Payee is any resident person. If payee is non-resident, then TDS will not be deducted in this section. You have to go to section 195. So TDS will be deducted in this section only when the payee is a resident person. When to deduct TDS at the time of payment or credit, whichever is earlier. When to deduct TDS at the time of payment of this commission to the agent or at the time of crediting agent's account, whichever is earlier. What rate? 5%. COVID special rate is 3.5% for the period starting from 14 May 20 ending on 31 March 21. Minimum amount not liable to TDS is 1,515,000. Minimum amount not liable to TDS is 1,515,000. See, have you learned some other commission? Today, have you learned some other commission? Yes, which one? Section 194D, insurance commission. Insurance commission also the rate of TDS was 5% and the minimum amount not liable to TDS was 15,000. Here also the rate of TDS is 5% and minimum amount not liable to TDS is 15,000. So rate of TDS and minimum amount not liable to TDS was same in 194D as well as 194G. Next is section 194H. TDS on other commission and brokerage. This is the third section talking about commission. 194D was insurance commission paid by insurance company to insurance agent. 194G was commission paid by lottery organizer to the lottery vendor. Besides those two commission, all other commission will be falling into section 194H. Brokerage will also fall into section 194H. So what is the nature of payment? All commission other than lottery commission, other than insurance commission. Why? Because the insurance commission you have separate section 194D, lottery commission you have separate section 194G. So all commission other than insurance commission, lottery commission, and all brokerage will be covered by section 194H. This is the nature of payment. Payer is, if the payer is other than individual HF, they will always deduct TDS. Whereas if the payer is individual or HF, then they should deduct TDS only if their business turnover was more than 1 crore or the gross receipt from the profession was more than 50 lakh in the last year. Your previous year is 2021, so you have to look at the gross receipt or turnover of the business of the last year, that is 1920. So every person will deduct TDS. Every payer will deduct TDS except those individual and HF in whose case the business turnover of last year do not exceed 1 crore or the gross receipt from the profession do not exceed 50 lakhs. They should not deduct TDS. All others should always deduct TDS. Pay is any resident person. When to deduct TDS? TDS should be deducted at the time of payment or at the time of crediting pay's account, whichever is earlier. TDS should be deducted at the time of payment or at the time of crediting pay's account, whichever is earlier. Rate of TDS is same as section 194D and 194G. That is 5%. COVID special rate is 3.75%. Minimum amount not liable to TDS is also same. That is 15,000 rupees. Now other important points. Meaning of commission or brokerage is given here. What do you mean by commission or brokerage? Commission or brokerage includes any payment received, receivable directly or indirectly, for acting on behalf of another person, for services rendered, for goods purchased, for assets purchased, or any other valuable article or thing purchased, not being securities. So when you purchase some goods, when you sell some goods, when you purchase some assets, when you purchase any other valuable thing, in that case, whatever commission you pay, either at the time of purchase or at the time of sale, whatever commission you pay to the agent, on that you should deduct TDS, except securities. So when you pay brokerage to the broker, when you purchase and sell the securities through the stock exchange, when you purchase and sell the securities through the stock exchange, you will purchase and sell the security through the stock exchange only through the broker, na? You have to place an order through the broker. You cannot place order directly in the stock exchange. You have to place your order with the broker. Broker in turn will place the order at a stock exchange. So when you pay brokerage to the broker, either at the time of purchase of securities shares or at the time of sale of securities or shares, on that brokerage you should not deduct TDS. See, why na? See, TDS mechanism intends to simplify the collection process. If the collection process gets complicated, then there is no point in applying this TDS provision. Therefore, wherever the collection mechanism gets complicated, government will say that TDS should not be deducted. When can we say that collection mechanism has become complicated? When more number of people are deducting TDS of less number of people. For example, if government says that fees paid by the student to the coaching class, they should deduct TDS. While paying fees to the coaching class, we should deduct TDS. If that is the provision, then what will happen? For example, in a particular coaching class, there are 5,000 students. Then what will happen? All those 5,000 students will deduct TDS while paying fees to the coaching class. Then they will pay this TDS to the government. Those 5,000 students will file the TDS return. Each of the students will issue the TDS certificate to the coaching class. Don't you feel this system will become more complicated? In fact, the purpose is to simplify the things. If more number of people are deducting TDS of only single person, then the system will get complicated. Therefore, government says TDS should not apply. In such situation, government will remove such situation out of the TDS provision. Instead of you all deducting the TDS of coaching class and paying to the government would prefer taking the tax directly from the coaching class only. Government would prefer collecting tax directly from the coaching class because life is simplified. Only one person has to pay the tax. Why government should go on collecting tax from 5,000 people? So whenever, generally what will happen, less number of people will deduct TDS of more number of people. Number of payer will be less, number of pay will be more. But whenever the situation is opposite to that, there are more number of payers deducting TDS and less number of pays. In that case, government will say that don't deduct the TDS. For example, I was talking about securities. There are more number of brokers in India, or there are more number of investors in India? Yes, definitely there are more number of investors. Brokers might be in 500 or maximum 1,000, but investors are into lakhs and crores. So all these investors are acquiring shares, securities, etc. through a broker. If all these lakhs of investors go on deducting TDS from the brokerage paid to the broker, then life of the government will become complicated. Lakhs of people will deduct TDS. They will file lakhs of TDS return. Therefore, government says when you pay brokerage to the broker for purchase of securities or sale of securities, you should not deduct any TDS. Government will collect tax directly from the broker itself. Yes, have you understood this? Yes or no? If you point number B says no TDS in case of in case of payment of commission by MTNL and BSNL to their PCO franchisees. See, nowadays there is no PCO franchising because nowadays mobile, in case of mobile, only outgoing charges are too less. But just before 5-10 years, not 10 years, just before 15 years, around 15 years before, there were PCO booths and STD booths throughout the country. Every lane you will find out that there is a PCO booth. So you can go to a PCO booth, put a 1 rupee coin and that 1 rupee coin in that PCO booth, in that telephone machine. You put it, drop a coin of 1 rupee, and you can make a call and you can talk for 1 minute. After 50 seconds, it will give you a beep sound, and once again you put one more coin, your call will be extended. If you don't put the coin, your call will be automatically disconnected. Such kind of PCO booths were available. So MTNL and BSNL, where they were providing PCO booths to their franchisees, and they were paying commission to them. From every 1 rupee, 10 paisa was paid to them. So on that, you should not deduct TDS. This point has become irrelevant in this world now. Practically, there is no PCO booth. Commission paid to employees. If the commission is paid to employee, then TDS should not be deducted in section 194H. It should be deducted in section 192 only. In case of commission paid to employee, if there is an employer-employee relationship, any amount paid by employer to employee is termed as salary only, and TDS should be deducted in 194, and TDS should be deducted in 192 only. This 194H section will not apply. If you are making payment to consignee, in case of consignee, when consignor is paying commission to consignee, he should deduct TDS. In certain cases, consignee will sell the goods on behalf of consignor. Whatever sale proceeds he has received, from that he would keep his commission and balance amount he will forward to the consignor. In those cases also, consignor should deduct the TDS. Consignor should deduct the TDS. Point number E. Point number E is commission versus trading profit. See, in case of trading profit, section 194H is not applicable. TDS is not required to be deducted. But yes, TDS is required to be deducted only in case of commission. What is the difference between trading profit and commission now? In case of trading profit, that agent might be an independent agent. In case of commission, generally agent is a dependent agent. In case of trading profit, we say that transaction between two persons is on a principal to principal basis. None of them is agent. Both are principal. In that case, amount received by agent is not a commission, it is a trading profit. But if there is a principal agent relationship, then yes, what is being paid is commission, which is liable for deduction of TDS in section 194H. So point is how to identify whether it is a commission or trading profit. There is a criteria to identify. Number one, if the agent is dependent, it is always commission. Agent is independent and the relation is principal to principal basis, then it is not commission, it is a trading profit. If the relationship is between two persons is of principal and agent, then yes, the payment is commission. So here we are saying that how to decide whether the payment is commission or trading profit. Different courts have prescribed different tests in their judicial pronouncements. So in different cases, courts have given different stands. The golden rule to decide is whether the payment is made, is to be considered as commission or not. For deciding that, you have to check whether the ownership of the goods or assets is passed on to the other party or not. If ownership is passed on, if the ownership and the risk associated are passed on, then it will be considered as trading profit. But if the ownership remains with the payer, then it is a commission. For example, Hindustan Lever Limited HLL is selling its goods to the sole selling agent by making an invoice. Now that sole selling agent will supply the goods throughout the country or maybe throughout the state. For that, sole selling agent is receiving some money. Whether that money received is a commission or a trading profit, it depends upon whether the ownership of the goods are transferred or not. If Hindustan Lever Limited is transferring the ownership of goods to the agent, if Hindustan Lever Limited is transferring the ownership of the goods to the agent, then we say it is a sale transaction. In that, whatever commission is earned by the agent, don't call it as commission, it is a trading profit. On that trading profit, tax is not required to be deducted. On the other hand, if Hindustan Lever Limited is just supplying goods to the agent saying that whenever there is an order, you should deliver. In that case, ownership of goods is not transferred to the agent. Ownership lies with the Hindustan Lever Limited only. Agent is just rendering agency services to the HLL company. So whenever some customer is placing an order, the agent will deliver the goods. In that case, we say that the agent is a dependent agent. Ownership is not getting transferred. Ownership of goods lies with the Hindustan Lever Limited only. In that case, what is being paid to the agent is commission, which is liable for tax deduction at source in section 194H. Is that very clear? Yes. Yes or no? Now we are left with this point number F, but I cannot do point number F right now. I cannot do point number F because for this you should have some understanding of section 194C. So I'm keeping aside this point as of now. Tomorrow when we start section 194C, After completing section 194C, I will come to section 194H and then we'll discuss point number F. So till now we have completed up to section 194H. Tomorrow definitely all these sections of TDS will get completed. TDS all section will get completed. Yes, so I'll wind up here. Bye bye everyone. Thank you. Bye bye.